Sam, can you hear me?
Yes, sir.
Yeah, I'm in as a finance. We have 9 people.
What you're in is what? I'm sorry.
Well, I should be as just as the finance, as the
Finance. Got it. All right. Let me see if anyone else is.
yeah. We've got
All right. The rest of them are logging in.
yep. And I guess when Peter gets on, he'll show the screen.
I'm sorry.
I guess when Peter gets on, he'll show his screen.
Yeah. I hope he's not going to make me answer. How's your day going?
Good. How about you?
Yeah, you know what? So it's okay. It's all right.
We got a little sunshine here. That's good.
Yeah.
We're hoping the Rangers win tonight.
Oh, yeah. I think they.
I hope they do. You never know. These 2 teams, man. Let's see. Yeah, I don't have anything from. Yep, looks good there.
Once we start this, we need to mute, correct?
Yeah, when you hit start, you can stay on your microphone on in case he talks to you, but you just want to. I hit record, and then when we're ready, we hit start broadcast in the top right.
Yeah.
And then just turn your microphone on and off as you want to.
All right. Oh, Peter's on.
You see Peter?
Yeah.
Howdy.
Hey. What's up, bud?
Going on?
How are you doing, my man?
Oh, just fine and dandy. You got me? You got my picture?
Yeah,
Got your picture.
look
Got a
at
little
you.
haircut, I see.
Nice.
I took a shower and everything.
Whoa.
Big day for me.
We got you should be good. Just let us know when to hit broadcast, I guess. You know, I know we're earlier, unless you want to go.
No, you know what?
Yeah, let's
How
let
do
him.
I share my screen? I got to share my screen.
Take your time.
Well, do you have to give me control for me to share my screen?
Let me see.
You
Make
should
it
have.
over.
It
Yeah, you should have it now.
says
Right? Okay, right now.
All right, I got it. Show my screen.
I like to stay in control, you know, Peter. I like to be asked, you know.
Let's see. So I hit share my screen, but now nothing's come up. Let's see.
Okay, I can see your. Okay.
So you're go to connected to go to webinar.
Yeah, we can see it. We can see. We don't see your actual PowerPoint yet, but we see your screen.
Okay. Let's see. You got it?
Yeah. It looks like not full screen yet, but oh yeah, you just don't have presentation on yet. Yep.
Let's see.
We had about 400 registered.
Nice. Let me see one here. You got that question up there?
Yeah, yep. We can see that we can't see, we can see question one. Okay. Okay. Now we see your keyboard. Okay. Now we can see one question and 3 answers. Yep. Yep.
Okay.
Right there.
Let's see. What color pen is it writing in? I don't like the color. This is so weird. This must be a new PowerPoint thing with these weird colors. Is it showing up like a black page?
Yeah, that blue writing, white and black background.
Not digging that. Hold on.
You're good. We got time.
Hey guys, no DJ today?
No, it's taking me. Uh-oh. I hope I didn't just cut you guys out.
We got
No.
you.
No, we're still
That's good.
It's so
Where's
weird.
the music, Pete? What's going on?
I know. Don't put pressure on me.
Take time. Take your time, buddy.
Where are the ratios? Now, how do I? Don't like that writing at all, and I don't need that.
It doesn't look bad, Peter. I mean,
Yeah, if I gotta go with it, but it's gonna I want to go to the other setting if I can. I don't even know how to get out of this mode now. See, like it's the fonts and all that stuff get highlighted. I want to get out of this. Let's see.
So Pete, having a good day?
Oh man, it is. You know, I went through way too many questions getting this set up. Way too many. But yeah, busy. So you know, I selected a ton of questions for this just in case.
That's all right. You know what? No one ever said that, you know, the buffet was, you know, no one ever complained because the buffet had too much food.
Yeah, exactly. So I prepped a ton of questions, 10 times more than I'm gonna need, but I figured I'd better be safe than sorry.
Amen.
This is so weird. That's that.
Whatever you don't use, you can save for the next level.
Yeah. Yep.
wish I could help you, Peter. I just don't. I can't.
Yeah. Let's see.
So I'm sorry, what's the issue on this?
Oh, there we go. That's how you do it. I think that's how you do it.
You trying to get in presentation mode?
No, I want to, I wanted to, there's usually a little, like, it looks like a little camera or something over there. Down here, I don't see that button today, but let's see.
What are you trying to do? I guess?
I wanted to get this. Let's see. Let's see. Property manager. Nope. All right, I'm gonna have to go with this as is. Unfortunately,
Is that any of those bottom buttons? I can't really read them on here, but on either side.
no. Nope.
It's a little bit wider. It's print layout.
All right, screw it. Right back where it was. Oh, man. All right, go with it like that. Let's see what color do I got. I don't want that color. Black would be hard to see, black on black. This is so bizarre. I've never had this happen. This must be like an upgrade to Microsoft PowerPoint. There must have been something that got pushed through.
Yeah.
It's not even let me change the color. Boy, oh boy, oh boy, oh boy.
Keep right click on your main screen and go to display options. You should be able to change the display color. I think it's like a theme that's changed. So on your desktop, go to your desktop
Yeah.
and
So I'm
right click. No, get
That's-
out of whatever. I see the question on the screen. Get the question off.
Okay.
So right click. Go to display settings in that list. Color profile maybe.
We're getting close. Let me bust this thing out. Sugar. Sugar, 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 sugar. Oh man, and this one's got all my inking on it. I wanted the clean one. Oh my god. Somebody want to say hello to the group? Tell them we'll be coming on in a minute.
Yep. So I hit start broadcast, right?
No, not yet.
I mean, oh, how do we go on? I'm not sure how to. Yeah, I don't know how to.
Can you send it through chat?
Yeah, send it through chat.
Okay. We're just about to start. Got almost 80 people. That's good.
Wait, all right, here we go. Draw. Now my drawing tools aren't working. What is going on?
Allow editing.
Did it say allow editing?
You have to allow editing. Otherwise, it's not going to let you make any changes. Okay, so
What is going on? This is wild. You know what, guys? I gotta, what am I gonna
Oh,
do?
it's in like read only mode, isn't it? It's not, you're not in editing.
Yeah, drag it to your desktop and open it from your desktop, not from the email.
Not let me drag it.
Yeah, you're like in read only mode. Looks like yeah, read only at the top.
All right, I gotta get out of read-only mode. How do I get out of read-only mode?
When you click, yeah,
downloading it?
upload your document. Yeah, I think he's right. You need to save it, get it on your hard drive, and then pull it off your hard drive.
We gotta get you a URL mug too.
I have never, ever had this happen before. This is incredible.
Okay. Now it's not saying read only anymore.
Yeah, but I can't, it's not letting me choose a color here. And then when I try to write, it's black. I got to switch computers, guys. I got to log off and then I'll log right back on.
Okay. Let him know.
All right, bye.
I'm gonna send a note, Sam. Well,
so
just gonna have to wait. Just wait. Nothing else we can do.
I know.
Yeah, I'm sure he feels stressed out.
Want to send another message?
Yeah, go for it, Sammy. Whatever you want to say, buddy.
No, I was asking if you did. So I just saw you said patience.
Yeah, I sent another one and spelled it correctly.
You want to type in like, so a guy walks into a bar.
What?
Humor, right? So
I
like,
can't- it's on my TV.
no, we're not going to do that.
Hello, hello.
It's really hard to hear you. So I'm just. There we go.
Sort of.
We can see you at the top of your head.
Yep.
I'm going to give you the conch. All right, you got it.
Let me get my microphone, the correct. Why is nothing showing up here? The right microphone? What in the wide world of sports is going on today? I got to tell you.
We can hear you.
How's the sound? Is it okay?
Yeah.
All right, then
Sounds
I'm going
great. Just we can see the top of your forehead.
camera because I can't get the camera going. What camera is this?
We can. It's on. It's on. It's just at the ceiling.
Yeah, it's the wrong camera. That's why. Hold on. You know what? I'm gonna have to go camera free. We're gonna have to go. Okay, did you ping me the share my screen thingy?
What was that, Pete?
The share my screen? Did you send?
You're not on there.
No.
Yeah, you're not showing up anymore as a presenter. You're not on here. I can't give it to you.
Can't get it to me?
You're not on here as a presenter. Like, does that make sense?
Okay, am I showing my screen anymore?
No, sir.
No.
No.
It says people can see your screen on my side.
I see a sign that says connected to go to the.
I'm not even listed as a presenter here.
You are.
Okay. And you may be.
There you go.
Got it?
Okay, we can see it now. We can see it.
All right, so I'm going with this sound, no camera, and let's rock and roll.
Okay, here you go.
Future CFA charter holders, welcome aboard. Sorry for the delay. I can't get my camera to work. It might be because I haven't showered in 2 weeks, so one or the other, but welcome aboard. We got serious stuff to do here. We are going to make you as prepared as can be for the FSA section, at least with respect to the subtopics we're doing here. So what I want to work with you, somebody's got a mute in the background. So we're going to be doing ratios, followed by we're going to do bonds, leases. We'll take a short break with the emphasis on short, and then we're going to jump in, and then we're going to do some earnings per share, and we'll finish up with my topic, show me the cash, statement of cash flow. So the goal is to use these questions to not only obviously answer the question asked, but the goal is to review the topic in its entirety. Okay, folks? So let's take a look at the first one. If you want to take screenshots, you're more than welcome. So they tell us the company has a new financial controller who has installed a new system to improve the efficiency of inventory management. I don't like that color. Let me get a red. There we go. So, folks, if you want to improve your inventory management, you want to get your inventory down, turnover up. Surplus adds no value. So one of the things management has to do is have the correct amount of inventory. So if they can reduce that inventory to get it to the amount that we need just in time, it's called a just-in-time system to satisfy demand, minimize your inventory, you can increase your turnover. When you can increase your inventory turnover, when you increase your inventory turnover, that will reduce your number of days to sell. And that's the goal, to get it out the door faster while making a profit on it. Now, the other thing we want to do, they tell us we've written off a large amount of our uncollectible receivables. So what's going to happen to our accounts receivable balance? That means our accounts receivable is going down. If your accounts receivable is going down, same thing. Your accounts receivable turnover, therefore, is going up. 365 divided by that reduction in accounts receivable, increase in accounts receivable turnover is going to reduce your number of days to collect. Now, what did they ask us for in terms of days? No, they asked us in terms of turnover. So both your inventory turnover as well as your accounts receivable turnover is going to increase. Obviously, you've recognized this part of a bigger puzzle, the cash conversion cycle. You want to be able to take your number of days to sell, add your number of days to collect. Those two get you a subtotal you got to remember for exam day called the operating cycle. We want our operating cycle to be less than or equal to the standard. This is heavily dependent upon your credit policy, folks. We don't want it too strict. We don't want it too lax. We'll see more of that in just a second. But your operating cycle, we want to sell quick, collect quick, operating cycle less than or equal to the standard. We then subtract our number of days to repay the vendor. Now, when it comes to subtracting the number of days to repay the vendor, folks, you want to stretch it out. You want to absolutely stretch it out. You want to take full advantage of an interest-free grace period. The only time you want to pay quickly is if they offer you a discount opportunity like that 210 net 30. Hey, pay your bills in 10 days, you get a 2% discount. That gets us what's called our net operating cycle. Our net operating cycle, also known as the cash conversion cycle, we also want that to be less than or equal to the standard. So if you take a relatively low number, subtract a relatively high number, that net operating cycle, lower the better. Okay, so your job on the exam is to be able to quickly calculate, if you're given math, the turnover as well as the number of days. Now, the only one I didn't give you, and I'll just put it here for you, must know formulas. If you take your cost of goods sold and you divide it by your average inventory, that gets you your inventory turnover. We want that inventory coming off our books. We want to be able to sell it quickly. Divide that into 365. There's your days to sell. You take your net sales, you divide it by your average accounts receivable. We want those receivables turning into cash. We want a higher accounts receivable turnover. Divide that into 365. There's your days to collect. You got to know this cold. And then those two get you your operating cycle. Then you subtract your number of days to pay. We'll probably take purchases, but it may have to be cost of goods sold. Preferably purchases if it's given. Divide that by your average accounts payable. There's your accounts payable turnover. Now, this is counterintuitive. We don't want to turn it over too quickly. We want to stretch it out. 365 divided by a lower accounts payable turnover, our number of days to repay the vendor, unless we're given an incentive to pay quickly, we want to stretch it out. So you can either use purchases or cost of goods sold, depending upon the facts, preferably purchases. So we want to stretch out those accounts payable. Don't pay it too quickly. All righty, one question down, 450,000 to go. Let's crunch some numbers. So the correct answer here again, choice A. Let's try another one, number 6. I'll give you a second, take a screenshot of it. There are your facts. A lot of facts, folks. We have no idea what to do with all those facts. Even more facts. Exam day, when you get a question with lots of given information, where do you start? Your question stem. You don't want to unnecessarily read through those facts without knowing what to do with it. So folks, they want the payables turnover ratio. All righty, so the first thing we're looking for, okay, how are we going to calculate that payables turnover ratio? So again, when it comes to payables turnover, you have two options. You're thinking either purchases divided by your average accounts payable, or cost of goods sold divided by the average accounts payable. There's no intent to deceive. It's really dependent upon the given information. For you to be able to calculate purchases, they've got to give you a lot of information so that you can back into that. Purchases is something that is not on the face of the income statement. So you need other information to back into that. Obviously, cost of goods sold is right there on the face of the income statement. And then for your denominator, you need a comparative balance sheet, a comparative balance sheet. All righty. Now, if they don't give you 2 years worth of information, well, then obviously you can't take an average. But when they give you 2 years worth of information, folks, you got to be ready to take an average. Now, income statement combined with balance sheet. Why is the balance sheet number an average if possible? Because remember on the exam, easy points, income statement is only for what? The current year, whereas the balance sheet is a cumulative financial statement. So when it comes to the balance sheet, are you using the beginning balance or the ending balance? Preferably neither one, added together, divide by 2. So whenever you mix income statement with balance sheet or cash flow with balance sheet, if possible, the balance sheet number should be an average. So folks, we got cost of goods sold. We've got accounts payable. I do not have 2 years worth of information. So my cost of goods sold, 75, divided by accounts payable. If they only give you 1 year's worth of information, then an average is not necessary. Then 2.5, therein lies our accounts payable turnover. Okay, so accounts payable turnover. And now you scan, and hopefully that's an answer choice. And it is choice B. Come on, screen. It's just one of them days. One of them days. Come on, man. Now my screen is frozen. That is not very nice. Boy, oh boy, oh boy. All right, while I'm waiting for my screen to cooperate, how do you get purchases? This formula is 2 for 1. You might have to use this with inventory questions as well. If you have your beginning inventory, your beginning inventory per a comparative balance sheet, we're going to back into purchases. Here we go. We're going to back into our purchases. That gets you something called cost of goods available for sale. Cost of goods available for sale. You subtract your ending inventory, and therein lies your cost of goods sold. So if you're given your income statement, your cost of goods sold, you're given both your beginning inventory as well as your ending inventory, you should be able to back into purchases. So applying that to this question, we know per the facts, let's see, our inventory, or actually I have another question where we have beginning and ending, but you must have cost of goods sold as well as a comparative balance sheet. All righty, so here we do not have beginning and ending inventory. We only have one period of inventory, so we can't back into purchases. So moot point, correct answer, 2.5. All righty, let's try another one. Let's jump ahead. Let's do return on equity, an exam favorite. Return on equity. Why is return on equity so important? You ready, folks? Must know. Profit margin times your turnover times your degree of financial leverage. Therein lies your return on equity. If you take your return on equity and you multiply it by your retention rate, therein lies your growth rate that you're going to need when you do your valuation, equity valuation, and you need growth in your Gordon growth model. All righty. Now, if all you need is return on equity, you don't have to do it using the DuPont model. If all they want is return on equity, well, then the path of least resistance is just going to be to take your net income and divide it by your average equity. Now my pen's not writing. What is going on today? I got to tell you. There we go. So net income divided by average equity. There's your return on equity. All righty. Now that fraction alone does not explain what's driving that return on equity. That's why we would prefer the DuPont model. Net income divided by sales. Competition, folks, not only current, but potential competition. Michael Porter's 5 forces. All righty, so is competition going up or down? As competition goes up, profit margins go down. Sales divided by your average assets. Management efficiency, folks. Having the right number of assets. You don't want to have too many. You don't want to have too few. So I'm just going to reverse this. Lower competition, higher profit margin. Lower assets, higher turnover. These two fractions obviously get us your return on assets, your net income divided by your average assets. So if you did some crossing out of your sales, therein lies your return on assets. But the profit margin and the turnover also give us that industry profile, how much competition we have, and then turnover. So on the exam, if they tell you, let's say we produce a product at a dollar store, it gets sold for 50 cents a unit, you know your profit margin's likely to be very low. We're going to make the bulk of our money through turnover, through volume. Okay, now degree of financial leverage, that's your amplifier. That amplifies the risk we're willing and able to assume. There's 2 ways to get your degree of financial leverage. 1 plus your debt divided by your equity, or average assets divided by average equity. Even though both the numerator and the denominator are coming from the balance sheet, the reason we want an average is because in the DuPont model, we will eventually be mixing with income statement. All right, so that degree of financial leverage amplifies the risk assumed as well as your potential return. So we want to break down the components of return on equity so we can better interpret and understand what's likely to continue going forward. Now, the retention rate, folks, you've got to be prepared to get your payout rate, your dividends per share divided by your earnings per share. Therein lies your payout rate. Or you could take your dividends declared per your balance sheet. You back into your dividends declared. I'll review that with you. Then you divide the dividends declared by your net income minus your preferred dividends. Folks, that is called income available to common stockholders. Income available to common stockholders. The dividends declared divided by the income available to common stockholders, that gets you your payout rate. Your retention rate is obviously 1 minus the payout. So this is going to pay dividends not only in accounting, but corporate finance as well as equity. Okay, so with that brief review, they want us to calculate return on equity. So the first thing I'm thinking, since it's just a math question, did they give me net income and average equity? Okay, do I see those pieces of the puzzle? No. So then I'm thinking profit margin times asset turnover times my degree of financial leverage. And obviously the balance sheet number should be an average if possible. I don't see any averages here. So I don't think we're going to have to worry about that. I do see my profit margin. We got one piece of the puzzle, 3%. I see my asset turnover, 1.5. We got another piece of the puzzle. And they've given us financial leverage, 1.8. So folks, 8.1%. All righty, therein lies our return on equity. All righty, now you can break down your profit margin if you want more explanatory information. We could break our profit margin down into our operating margin, EBIT divided by sales. Again, heavily dependent upon competition. Michael Porter's 5 forces. Do the customers have the power? Do the vendors have the power? We want this to be higher, the better. Earnings before tax divided by EBIT. Same thing. It's how much we're retaining after we cover our interest burden. Do not get confused by the term interest burden. Even though they call it a burden, it's really what we're retaining after we cover our interest burden. This is heavily dependent upon their degree of financial leverage, their capital structure, their cost of borrowing. Is it fixed? Is it variable? And then lastly, net income divided by earnings before tax. This is the income we're retaining after we cover our tax burden. So again, even though it's called a burden, the higher the ratio, the better. We want to retain as much income as we can after covering our tax burden. All righty, so folks, tax burden, political factors. What are they likely to do with that tax rate? All righty, so we could break down our profit margin into 3 components and go from the 3-stage DuPont to the 5-stage, wherever they want. Okay, so return on equity, you're going to be prepared for that, but it's not always math intensive, folks. Sometimes it's a theory question. Take a look at the next one. All righty. So in this question, again, we start with the question stem. You ready? They want to know these numbers, what can they be explained by? So we're looking at financial leverage and what's happened to the profit margin. So let's see what's going on here. Year 1, prior year, year 2, obviously our current year. So our return on equity has improved. Our return on equity has improved. I've got return on total assets and I've got my total asset turnover. So profit margin times turnover, that gets you your return on asset times your degree of financial leverage. Therein lies our return on equity. All righty, so now we know our return on equity has improved. It went from 8.9 to 9.4. What's happened to return on total assets? That has declined, yet return on equity has improved. So if your return on asset has declined, but nonetheless your return on equity has improved, what do we know for sure? Degree of financial leverage must have increased. That must outweigh the decline in the return on asset. So folks, your degree of financial leverage must have increased. Okay, what else do we know? Our return on total assets, okay, we know that declined. Now, why did return on assets decline? What happened? Well, our total asset turnover actually improved. Our total asset turnover went up. So why would our return on asset decline? We must have had a reduction in our profit margin. Our profit margin must have decreased. So what can we infer, folks? A decrease in profit margin, we would think competition has gone up. We must have a loss of market share or maybe a reduction in the selling price, some kind of loss in demand. All righty. Now, be careful with that degree of financial leverage. A lot of overlap here with corporate finance. All righty. So when your degree of financial leverage is higher, there are pros and cons, folks. Your ethical obligation to your client is to talk about the upside and the downside. Rarely are things all good or all bad. So think about it. When you have a higher asset and lower equity, when you have a higher degree of financial leverage like we have in this problem, think about your balance sheet. Well, if you have a lot of assets and you don't have a lot of equity, well, that means you must have a lot of what? Debt financing. Okay, so a higher degree of financial leverage could lead to a higher return on equity because you don't have a lot of partners, folks. In this capital structure, you don't have a lot of partners. So you're thinking you're going to have a higher return on equity. The major con, though, is your financial risk is going up because of all that debt. The principal and interest legally required. It's got to be paid as it becomes due. So higher return on equity, but you're assuming more risk to get that higher return. Now, in corporate finance, folks, your degree of financial leverage, all right, that amplifier. Rarely do you want to combine a high degree of financial leverage with a high degree of operating leverage. If your operating leverage is lower, then theoretically you're able, I don't know if you're willing, but you're able to have a higher degree of financial leverage. But if you already have a high degree of operating leverage, what's operating leverage? High operating fixed costs. You already have a lot of rent. You have a lot of insurance, a lot of depreciation, costs that do not vary with sales. Then you are not able, you might be willing, but not able to assume a higher degree of financial leverage. All right, so a lot of times the degree of financial leverage is dependent upon what your degree of operating leverage is already. In addition, control. Are you willing to give up control? When you issue more equity, you've got to be willing and able to give up that control. All righty. Now, let's try another one. Let's get a nice juicy one for you. Here, let's try number 12. We'll jump ahead to number 12. Take a second. Take a picture of number 12, get it all set. All righty. You ready? They tell us we got a manufacturing company. They have a very low asset turnover. So we're always ready for the math questions. Remember, or maybe not even remember, maybe you didn't even know. Folks, more than half the time on the exam, you're not going to be picking up your calculator, not even for these theoretically math-intensive topics. They want to make sure you're not merely memorizing the calculation, you actually understand it and can interpret it. All righty, so we have a very low asset turnover. So net sales divided by your average assets. And again, my pen, come on, pen. Don't let me down. Let's go. All righty. Pen is not working. Come on, baby. I'm going to shut that down, bring it right back up. Hang with me, hang with me. Sam, let me know if you can see my screen when I bring this back up. You got it?
Yes, sir.
Beautiful. So we got net sales divided by assets. You ready? You have, what's the given information? We have very low total asset turnover. This we know is low. So what does that mean? Our assets are higher. Now, why would your assets be higher relative to competitors? Folks, your assets are per your balance sheet. Assets and liabilities are on the balance sheet at book value. All righty, so be careful. Sometimes you have a lower asset turnover. Why? Because maybe your assets are newer, or maybe it's due to different methods of accounting or different estimates. All right, so if you have newer assets in an inflationary environment, that might explain why your asset balance is higher. So not older, okay, they're newer. All righty. What about second choice? The company has too much capital invested in the assets. Maybe that's what it is. Maybe your assets are too high because you have too many stores, too many factories, too much inventory. So that is a possible answer choice. How about choice C? The company uses operating leases rather than an outright purchase. That would no longer apply because whether it's an operating lease or a purchase, asset is recorded on the balance sheet. We're going to cover leases in just a little bit. So that's not going to be the answer. So the best answer is going to be choice B. Now, folks, remember, with asset turnover, if they tell you that a company has lower assets, higher turnover, that makes it appear as though the company is more efficient. But we're not sure that's really the case. You might have lower assets because they're older, or maybe you're using accelerated depreciation. All righty. So just because you have higher turnover does not guarantee you're more efficient. When you compare it to the competitors, you got to make sure they're using the same methods of accounting and they have similar age assets. Otherwise, you're going to get misleading information. All righty. Let's try another one. Fun stuff here. Here we go. You ready? Return on invested capital. ABC Corp, return on invested capital. So the question is, how do we get return on invested capital? I'm afraid to change the color. I should have just left it alone. You ready? Return on invested capital. First of all, what is total capital? That is similar to total assets. They're not exactly the same thing, folks. If you take your total assets and you subtract your operating liabilities, non-interest bearing, that's how you get total capital. Or another way to get total capital is to take your financing liabilities, all of your interest bearing debt. Mostly that's long-term, but it could be short-term as well, plus your equity. All right, so there's two ways to get total capital. The easiest way is probably to take your total assets and back out your non-interest bearing liabilities, your operating liabilities. All righty. Now, what about the numerator? You've heard of NOPAT. What is NOPAT? You take the company's EBIT, their earnings before interest and taxes, multiply it by 1 minus the tax rate. You get what's called net operating profit after tax. Divide that by total capital. There is your return on invested capital. Okay, why do we use EBIT? Because interest is the return to the creditors, right? And then your earnings after tax, that's what's available to the stockholders. So we need NOPAT divided by total capital. So now, legalize cheating, right? Just make sure that formula comes out of your head and not a piece of paper in your pocket. Now I want to take a look. What did they give me? So I need net income, excuse me, I need EBIT, not net income, EBIT times 1 minus my tax rate. So I see my net income. Here's my operating profit, your EBIT. All righty, therein lies your operating profit. Sales minus your cost of goods sold, gross profit, minus your SG&A. Therein lies your EBITDA. Minus your depreciation and amortization. There is your EBIT, your operating profit. So in this example, we didn't have to solve for it, given information. Now, what is my tax rate? Well, I know my operating profit, my EBIT is 55. Okay, I know my interest is 15. So that gets me earnings before tax of 40. I know my taxes are 10, and we know our net income is 30. Folks, what must be our effective tax rate? What's got to be our effective tax rate? Well, your taxes divided by your earnings before tax, your tax expense divided by your earnings before tax, that gets you what's called your effective rate. So folks, with the tax of 10 and an earnings before tax of 40, we know our effective rate, 25%. So we got another piece of the puzzle. All right, so our effective rate, 25%. EBIT times 1 minus that tax rate. So that gets us a NOPAT. Our net operating profit after tax, 55 times 1 minus the tax rate. So of course I can't read my own handwriting. It's just one of them beautiful, beautiful, beautiful days. You gotta love the challenge. We don't like it easy. Come on, man. So 55 times 75%, 41.25. That is my NOPAT. So we got another piece of the puzzle. Now we need our total capital. So I'm looking, did they give me total assets? So we're looking, hopefully they gave us total assets. So let's see. They gave us total liabilities and equity is the same thing as total assets. It's why your balance sheet balance is. So total assets, 280. Did they give me my operating liabilities? Yes, they did. Accounts payable, non-interest bearing. Take your total assets, 280. Subtract your operating liabilities, 30. What would be my total capital? 250. That's one way to do it. Or add up your pieces. Your financing liabilities, anything that's interest bearing, whether it's short term or long term, 85. Add the common stock and the retained earnings, 165. Same result, different format. Total capital, 250. All righty. So let's now plug it in. 41.25 divided by 250, 16.5%. You say, whoop, there it is. All right, return on capital, that's a measure of performance, folks. Anything that deals with profitability, folks, your performance metrics. Anything that deals with return, whether it's return on asset, return on equity, if it deals with profitability, if it deals with turnover, okay, a measure of efficiency. These are all performance metrics. So we look at the income statement predominantly to assess performance as well as operating risk. That degree of operating leverage, your standard deviation in sales, your standard deviation in EBIT, your volatility, your operating risk. All righty. Your balance sheet, we predominantly look at to determine what? Financial risk. And remember, there's two types of financial risk. Short-term risk, the liquidity, your ability to pay your debts as they become due, and then your solvency, your capital structure, how you raised your capital, what combination of debt and equity. Liquidity, we look at things like what? Current ratio, the quick ratio, the cash ratio, the defensive interval, all those things we'll see in a little bit. All righty. Now a little equity mixed in. What is the PE ratio and what's a reason not to use it? PE, not intrinsic value, relative value. We want to try to figure out, is something a good buy? Is it relatively undervalued such that we want to buy it? Or is it relatively overvalued such that maybe we don't want to buy it? Maybe it's overvalued. Or maybe it's high growth. All righty. So relative valuation metrics, very popular. Price to earnings. That's really price divided by earnings per share. Price divided by earnings per share. All righty. I'm going to stop again. No worries. No worries. Don't save. Let's go. Let's open it up again. I like this. So price divided by earnings per share. Folks, we're going to cover earnings per share. How do we get earnings per share? How do we get earnings per share, folks? What's in your numerator? Income available to common stockholders. All right. Income available to common stockholders. So price divided by earnings per share. That's your net income. Minus your preferred dividends divided by your weighted average common shares outstanding. Your income available to common stockholders. What makes a company attractive when they have a lot of income available to those common stockholders and they don't have a lot of partners? When they got a high earnings per share, when their multiple is relatively lower than everybody else, relatively lower, that could indicate, we're not definite, that could indicate that they're a value stock, that they're cheap. We want to buy them. All righty, that could indicate. Now, what's another reason why you might be trading at a lower multiple? Why trading at a lower multiple? What are other explanations for why a company might be trading at a lower multiple? Folks, that net income number, this is accrual basis, accrual basis. So maybe it's due to methods of accounting. Methods of accounting. You might have a higher net income because they're using very aggressive methods when accruing for their expenses. They're using methods that are very aggressive, resulting in lower expenses, higher net income. It could be due to estimates being very aggressive. When you accrue for expenses, the matching principle. Matching principle. Again, they might be using methods that lead or estimates that lead to lower estimated expenses for warranties, bad debts, depreciation, cost of goods sold. They might be using FIFO where everybody else is using LIFO. I don't know. What's another reason why you could be trading at a lower multiple? You might have higher risk. You might have a balance sheet where you have much more liabilities and less equity. So you might have a much higher degree of financial leverage. What's another reason you might be trading at a lower multiple? Maybe you have less growth potential. All right, there's a lot of reasons why you could be. Now, if none of these apply, then we could come to the conclusion, yeah, I think they're relatively undervalued. I want to buy them. Okay, that could indicate they're a value, cheap. All right, but a major reason why, or a major limitation of the PE ratio is net income can be manipulated. That's why you might want to switch to what? Price to cash flow per share. Because with price to cash flow per common share, if you're using cash flow from operations or maybe free cash flow to equity and dividing that by the number of common shares outstanding, anything with cash flow is inherently more objective because we don't have the methods and estimates manipulating, okay? Beautiful, getting excited. You guys getting excited? Let's do some more. All right, we need a more challenging one. Sam just yelled at me online. He said, Pete, these are ridiculously easy. If you don't make them more difficult, he's gonna fly to New Jersey and throw me a smack. So here we go. Are you ready? Let's jump ahead. Let's try another one. So let's jump all the way ahead. Let's get a nice juicy one here. Let's jump ahead. Number 20. Long set of facts. Ready? First thing you want to do when you get a long set of facts is do what? Read the question stem. What is it that they want from me? You ready? They want to know what's happening to their liquidity position. Short-term risk of distress. So folks, what are we thinking? Current ratio. The more current assets you have, the bigger the spread, the lower the risk, but probably a lower return on assets. Why? Because when you're hoarding a lot of cash and receivables and marketable securities, you're probably not going to get a very high return. All righty, so what's happening to our liquidity position? So we're going to look at our current ratio. All righty, so we're looking for the trend. Did it improve or did it deteriorate? So let me see if I can get both of these up here simultaneously. So my current assets, this column, by the way, is your prior year. Here is your current year. All right, so you always want to be careful. Okay, prior year, current year. So total current assets, you ready? Current assets divided by current liabilities. Here's my metric last year. Here it is in the current year. So 26.6, 31.6. Now we're looking for our current liabilities. Where are our current liabilities? Slide down a little bit. Current liabilities. 8,500 last year, 12,300 this year. So 8,500, 12,300. So 8,500, 12,300. Where did my writing go? It disappeared. There we go. So 8,500, 12,300. Drop the zeros so you can move more quickly. So if you put in 8,500 and my pen stopped working again, 8,500 and 12,300, folks, you could crunch the numbers. It went from 3.13 down to 2.57. It decreased. So 8.5 is your denominator for the prior year. 12.3 is your denominator for the current year. All righty. So it got worse. It got worse. Whenever your current ratio declines, it is getting worse. You're getting riskier. Okay, you're getting riskier. It's gonna be fun. We gotta close it, open it, close it, open it. I like it. Okay, now, question number 21. Ready? Give you a second, take a picture of it. This is 2 for 1. This could be ratios. This could be an inventory. You ready? We're looking for ending inventory. All right, so what kind of metrics did they give us? They gave us payables turnover. How do we get payables turnover? Well, one way of getting payables turnover is to take your purchases divided by your average accounts payable, and therein lies your payables turnover. So we know our payables turnover is 8. We know our denominator, our average trade payables is 11. So we have our numerator, 11 times 8, 88. There are our purchases. Now remember that formula, beginning inventory plus what you purchase. That's everything you have available for sale, cost of all goods available for sale. And then either you sold it or you didn't. Subtract what you sold, and therein lies your ending inventory, right? You could reverse this, whatever they give you. So we're looking for ending inventory. Okay, we're looking for ending inventory. So our opening inventory, synonymous with beginning inventory, 32. We know we have purchases of 88. So that means we have 120 available for sale. Righty? Now, what did we sell? Well, our cost of goods sold is 74. So what remains unsold in ending inventory? Well, then our ending inventory has to be what amount? 46. Okay, 46. Not so bad. All right, come on, man. We got to increase the level of difficulty here. Let's jump ahead. Let's not jump around. Let's jump ahead. Yeah, I like this one, baby. Here we go. Let's do, this is number 27. So number 27. Here we go. Starting with the question stem. They want our financial leverage for 2009. Financial leverage for 2009. Soon as I see what they're asking for, step number 1, you write your formula. Okay, your financial leverage. Ready? 2 ways of getting your financial leverage. And by the way, financial leverage is a measure of what again? Long-term risk, solvency, your capital structure. Okay. Now, they just said for 2009. So do we want to use the beginning of the year information? Remember, this is asset divided by equity, or 1 plus your debt divided by your equity. Remember, this gets mixed. This is in the DuPont model. This gets mixed with net income. So if possible, what would we like? If given, what should we take? Average assets divided by average equity. Okay, or you could take your leverage ratio at the beginning of the year, which I'll do here, and your leverage ratio at the end of the year, add it together, divide by 2. So let's take a look and see what we got. We have 2 years worth of information. Okay, we have 2008 last year, we have 2009 current year. Since we have 2 years worth of information, we should take an average. All righty, so average assets divided by average equity. So let me go to my total assets. Here we go. This is the prior year. Here is the current year. All righty, our average assets added together, divide by 2, 325.5. Okay, 325.5, there's your average assets. Okay. Or if we did it 1 year at a time, you could work with end of the year, beginning of the year, divide by 2, whatever you want to do. Total stockholders' equity, Add it together, divide by 2, 206 plus the 217.5, your average equity, 211.7. I think it's a lot easier to just take your average assets divided by your average equity. Average assets divided by average equity. So 325.5 divided by that average equity, 211.7. You ready? That gets you an average for 2009, 1.54. That is our average degree of financial leverage. Okay, our average degree of financial leverage. Okay, or if you had done it 1 year at a time, just to illustrate, 2009, your asset, 364.5, your equity, 217.5, 1.67. Okay, 2008, 286.5, your assets prior year, your equity prior year, 206, 1.39, add the 1.67, the 1.39 divided by 2, same result, different format, 1.54. Okay, so obviously this is part of a bigger puzzle now. What do we need that degree of financial leverage for? Again, the DuPont model. Okay, so when you take your return on assets, your net income for 2009 divided by your average assets times your degree of financial leverage, you got to make sure you're using average assets divided by average equity, 1.54. So in this question, our net income for 2009, it's current year net income. Our current year net income, 53.9. 53.9. Average assets, 325.5. Multiply that by 1.54. You get return on equity, 25.5. And our return on assets, while our degree of financial leverage was 1.54, what was our return on asset? 16.56%. 16.56%. All righty, so that degree of financial leverage worked for us. All righty, so that means it's making our return on equity greater than our return on asset. How do you know in corporate finance, how do you know whether or not leverage is going to make your return on equity greater than your return on asset? So long as your return on asset is greater than your after-tax cost of debt. That's your hurdle, folks. When you borrow, it's your after-tax cost of debt. So long as your return on asset is greater than your after-tax cost of debt, leverage will be positive. It'll make your return on equity 25.5 greater than your return on asset. Okay, so you got a good feel for ratios. Let's move on. I want to do some debt. Now, debt is going to appear in multiple places on the exam, folks. It's going to appear in financial statement analysis. It's part of accounting. It's part of corporate finance, obviously, and it's also part of asset valuation. All right, so it appears multiple places on the exam. Look at all the beautiful questions, by the way. I can't give these to you all. Sam would kill me, but in our database of questions, and this is not even all of them. This is a sample of all the questions we have. It's incredible. So I want to do, we'll do bonds next, and then we'll do leases. So let's do some bonds, and I'm going to review it with you from both the perspective of the issuer, which is accounting, as well as from the perspective of the investor. All righty. Oh, actually, before I do that, there was one more question I just wanted to do with you, if you don't mind, real quick, and it's got some overlap with credit analysis, credit policy. Again, I want to show you how these things could be asked in theory. So this one is 2 for 1 again. It's kind of accounting, but it's also corporate finance, a little bit of credit analysis. Okay, so with this particular question, 52, You ready? Credit management issues. So let's see what they tell us. Which of the following is most likely to suggest that a company's low receivable turnover is due to credit management issues? So folks, when you have low accounts receivable turnover, net sales divided by average receivables, your receivables are not turning into cash. Your accounts receivable turnover is too low. Your number of days to collect is too high. Your number of days to collect is too high. What could be causing that? A very lax credit policy. You know those commercials? No credit, no problem. Well, here's the deal with a lax credit policy. Your inventory turnover is likely to be higher. Your number of days to sell is going to go down because you're giving to credit to anybody who walks in the door. I know this guy Doug who works at UWorld with me. He's got no credit. He goes to these places, buys cars on credit, even though he has a credit rating of like 5, and they lend him money to buy these fancy cars because they want to turn over that inventory. They want to get the number of days to sell down. But the problem is when you have a lax credit policy, your accounts receivable are not going to turn over. Your number of days to collect is going to go way up. So that's the bad news. You have a lax credit policy. Now, what's evidence of a lax credit policy? You have a lot of bad debts. That means you have a lax credit policy. You're lending money to people and then you have to write off the accounts receivable. You wind up writing off those accounts receivable. You sell it, but you sell it to people who can't pay for it. Now, the flip side of that coin, how do you know on the exam they have a very strict credit policy? Look for situations where their number of days to sell is too long. Their inventory turnover is too low. They may not lending money unless you got like Sam, like an 850 credit score. All righty, but the number of days to collect is going to be lower. You're going to have no problem turning over those receivables. So there's good news, bad news. What's the optimal credit policy, folks? The optimal credit policy, you've got to balance these two, is when your operating cycle goes down. All right, when you have a strict credit policy, there's going to be bad news and there's got to be good news. When the good news outweighs the bad news, that means it's the optimal credit policy. You've minimized your operating cycle. Okay, and that's the goal, to minimize that operating cycle. Okay, so let's jump ahead now. I want to do some bond questions with you. Now, you know what I want to do? I found a hard one. You know what? I like when it's this hard. I get very excited. I think that these are questions worthy of you. I'm sorry. I love the ratios, but we are going to do bonds and leases. Probably, by the way, we're not going to go to just 9 o'clock. We got started a little late, so figure about 11:30, 12 o'clock tonight. All righty. So take a look at number 56. Give it a screenshot. I'll leave it there so you have the facts. What do they want us to do with these facts? You ready? Which of the following is most accurate about Jupiter for the year ended 2012? Well, let's see. When they give you nothing to work with, then go to your answer choices, folks. You got to try them one at a time. It's open-ended. So they want to know how much of the total assets are financed with debt. Well, let's see what we got. You ready? How much of those total assets, and this is for the year ended 2012. Okay, the year ended 2012. So let's see what we got. You ready? I got a debt to equity of 1.2. What does that mean? Well, I want to see what my capital structure is at the end of 2019. All right, so here it is. Excuse me, at the end of 2012, I got a debt to equity of 1.2. Take your debt, divide it by your equity, 1.2. Make up an easy number for equity, like 10. It could be any number you want. 10 times 1.2, that means your debt's got to be 12. The sum of the two is 22. What percentage of those assets are financed with debt? Well, 12 divided by 22 is what percentage? Well, 12 divided by 22 is 0.545%, 0.55%, not 0.60, not 60%. All righty, so I know that's wrong.
All right, try the next one. Every dollar in total equity supports $2.5 in total assets on average. Don't use the year end. Now we want average. Okay, now we want average. So let's see what they tell us. Okay. Ready? I want my balance sheet again. But now I want to use average information. Well, they tell me I've got a return on equity of 10%. Start there. Net income divided by average equity is 10%. Agreed? Okay. So I want this average equity number. Okay, I know my net income is 100, given information. So 100 divided by 10%, working backwards, what's got to be your average equity? Well, this has got to be 1,000. So my average equity has got to be 1,000. Okay, so we got one piece of the puzzle. All righty. Now, I want my average liabilities or my average assets. What else do I see? What kind of other given information do I have? Well, I've got information regarding assets. I got asset turnover, 20%. So now I'm looking for average assets. Well, sales divided by average assets. There's your asset turnover, 20%. All righty, 20%. Now, do I have my sales number? Well, let's see. I got my profit margin and I've got my net income. So my net income divided by my sales, that's my profit margin. Agreed? You got a profit margin also of 20%. Okay? We know our net income number is what? 100. So let's solve for our sales. 100 divided by 20%, what do our sales have to be? 500. We got another piece of the puzzle. Sales are 500. Now with asset turnover of 20%, we can now back into what our average assets have to be. 500 divided by 20%. What's got to be my average assets? 2,500. My average assets are 2,500. All righty. So, ready? For every dollar I put into equity, for every dollar in total equity, that supports how much in total assets? What's the relationship between the assets and the equity? Asset divided by the equity, 2.5 to 1. Just dropping the zeros. 2.5 to 1. There's your correct answer. All righty. Now let's get to the bonds. I promised. I love the ratios, but we're going to do bonds. So now the bond questions. Here we go. Bonds, 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 bonds. Folks, for the bonds, not only is this heavily tested in level 1 and 3 topics, but it's also heavily tested in levels 2 and 3. So this will follow you folks into levels 2 and 3. You want to have an outstanding foundation with the debt. You've got to know it from the perspective of both the issuer as well as the investor. Obviously, the asset valuation is from the perspective of the investor. All righty. FSA and corporate finance is going to be from the perspective of the issuer. So let's do it. We're getting there. Sam, how you doing? Do you want to say hello to the group as I'm scrolling along? You want to say hello, Sam?
Well, yes, thank you, Pete. I just hope everyone is enjoying this great presentation, and we hope to be able to see more of it.
Yeah, I'm sorry, I can't get my camera to work, but when you don't shower regularly, you put your camera on.
Next
time. And I got lots to do here, folks. So we're going to do the bonds now, and then the leases. Then I don't know, Sam, should we give them a break or just work right through? I say we work right through. Who needs a break?
I don't know. Send us a chat.
Take a poll.
Go through.
All right, but no breaks yet. You ready? Let's do a bond question. So, folks, here we go. Discount bonds. How do you know it's a discount? Coupon divided by price. Folks, your price is below the par value. That means the yield to maturity, also known as the market rate. The yield to maturity, the market rate has got to be greater than the coupon. All righty. So your yield to maturity is going to be greater than your coupon. All righty. Now, anytime the bond is sold at a discount, that is a loss to the issuer. A loss to the issuer. That is a built-in gain to the investor. A discount is going to make your interest expense greater than your coupon paid. For the investor, that'll make your interest income greater than the coupon received because you bought the bond at a discounted amount. All righty, so let me just make up numbers. What if a $1,000 face value bond is sold for only $900? Your initial carrying value, folks, always has to equal the net proceeds. So your initial carrying value has got to equal the selling price of the bond. So that means our discount in this example has got to be 100. That is unrecorded, but we don't use the word unrecorded because smart guys like Sam like to use code language so that the average person doesn't understand what we're talking about, so that we could charge $800 an hour for our advice. But an unamortized discount in English is a loss. You borrowed $900, but you got to repay $1,000. Your financing inflow is less than your financing outflow. You took in $900, but you got to repay $1,000. That's a loss. But rather than booking the loss immediately, we will spread it out over the life of the bond by making the interest expense greater than the coupon paid. Okay, so we will spread it out over the life of the bond. Okay, now, so they want to know what's going to happen to the book value of this liability. You ready? What's going to happen to the book value? So what we do is your interest expense is a function of your initial carrying value times your yield to maturity at issuance. So I'm going to make up numbers, okay? I'm just going to make up numbers. Let's say the coupon we offered is 8%, but the yield to maturity was 10. All righty, so just making up numbers. You ready? Your interest expense at 10 is greater than the coupon paid 8. This understates the cost of borrowing. That understates your cost of borrowing, folks. It would have been 8 had you sold the bond at face value, but you didn't collect face value. That understates the cost of borrowing. All righty. So that means your cash outflow under US GAAP and probably IFRS, interest paid, let's say it's classified as an operating outflow. The cash outflow understates the cost of borrowing. It understates the cost. It's at 8. That means your cash flow from operations, folks, is overstated. All righty. Now that initial carrying value times, that's your interest expense. That's going to be greater than your coupon paid. The difference between the two is the amortization of the discount. In English, that is a little piece of the loss that recorded that year to adhere to the matching principle. As you amortize the discount, folks, as you amortize the discount, you know what happens to the unamortized amount? That goes down. So what's going to happen to the carrying value of that debt over time? It's going to increase. The book value of that liability is not going to decrease. It's going to increase each year as we record that discount. I'll show you an example with numbers in a second. All righty. Whenever a bond is sold at a discount, true or false, does the interest expense exceed the coupon payment? Yes, it does. The interest expense is greater than the coupon paid. Your interest expense is your yield on that bond when you issued it, the yield to maturity. The only time the coupon represents your cost of borrowing is when the bond is issued at par. All righty. So let's try another one. Let's do some math. You ready? Let's jump ahead. Let's do some math. So, let's try this one. Ready? 135. Take a second. Take a picture of it. Let's bang it out. All righty. Start with your questions then, folks. They don't want interest expense year one. They want interest expense what year? Year two. What is the future value of this debt? Well, let's see. They tell us we issue an 8% coupon with a face value, a par value of $100,000. The term is 4 years. How often are we paying the coupon? It's annually. The market rate is 9. Stop right there. Coupon divided by price. The market wants 9. We only offered 8. Anytime the market wants a rate higher than what we've offered, that means the price is going to be what? Discounted. Not because you memorize, but you figure it out. Coupon divided by price, yield. You reason your way through it. So we know it's going to be issued at a discount. Now, from the perspective of the investor, what's going to be the purchase price, the value of this bond? What is going to be the purchase price? What's going to be the value of this bond? That dictates to the issuer their cash proceeds, okay? That dictates to the issuer the cash proceeds when they sell the bond. All right, so here we go. Future value, $100,000. That's the face value. What's the payment? 8% coupon, $100,000 times 8%. Do not multiply it by a half because it's annual pay, annual. What's our number of payments? 4. What's the yield? 9%. So folks, what's the present value? What is the selling price of this bond? $96,760. Yet the face value is $100,000. Your financing inflow is less than your financing outflow. Our initial carrying values also got to be what amount? $96,750. It's got to be the same thing as your selling price. So what is the difference between $100,000 and $760? Well, my unrecorded loss, my discount, is $3,240. That is my discount, unamortized. As we record the discount, the carrying value is going to go up. Okay, so we know our coupon paid is constant, $8,000. The question is, what's going to be our interest expense? You ready? Initial carrying value, $96,760 times the yield to maturity when the debt was issued. This is called the effective interest method, constant yield, the exact same yield every year. This is called the effective interest method. $96,760 times the yield to maturity when issued, not the current yield when it was issued. $8,708, therein lies your interest expense. Yet your coupon paid is only $8,000. What's the difference? A little piece of the discount, a little piece of that loss just got amortized. All right, the unamortized amount goes down, so that means the carrying value is going to go up by $708. So now the carrying value is $97,468. What's my interest expense? Not year one, they wanted year two. $97,468 times 9%, $8,772. $8,708 was year one, $8,772 is year two. Coupon paid again, $8,000. How much of that loss did we record this year? $772. And then you add 772 and so on and so forth. Notice, as your carrying value goes up, what's going to happen to our interest expense? It's going to go up with it, okay? The way you record that loss, according to the matching principle, your interest expense is going to be greater than the coupon paid, all righty? Not so bad. Let's try another one. So obviously the price went up by 772. Let's do this one. You ready? They want, start with the question stem. What is the value of this liability at the beginning of year 4? All right, same facts. We issued an 8% coupon bond, par value 100,000, the yield 9. So coupon divided by price. The yield was 9, greater than the coupon 8, so we know the price again was discounted. What's the value of this liability at the beginning of year 4? Please do not work out an entire amortization schedule. That's going to take way too long. That's not the right way to do it. Please do not do that. Do not carry this out, extrapolate out. That takes too long. Do not do it that way. Watch this. You ready? What's the value of that bond? Ready? Original term was 4 years. We're at the beginning of year 4. 4 minus, this is our total time, total term to maturity. 3 years have elapsed. 3 years have elapsed. We're at the beginning of year 4. So what's your remaining term? Your remaining term, folks, is only 1 year. So what's our future value? $100,000. What's the remaining term to maturity? 1 year. That's it. What's the payment? $8,000. What is the yield? 9%. We're looking for, you ready? The present value, $99,083. That is the easiest way to do it. Okay. Or we have principal and interest coming at the end of this year. We've got principal and interest coming, right? We have principal of 100,000 plus our last coupon of 8,000 discounted back at 9% for 1 year. What's your present value? 99,083. Not so bad. 99,083. All right. So theoretically, the value of anything is the sum of the present value, the future cash flows. So folks, the present value of this bond when it was issued, you got an $8,000 coupon, $8,000 coupon, $8,000 coupon, and then you have your principal and your interest in year 4, annual pay. Single yield to maturity. We could discount each and every future cash flow back to today using a single yield to maturity, right? That's what we're doing. The fractions take way too damn long, way too damn long. So we don't want to do it that way. All right. So when we originally issued this bond, what did we say we sold it for? We said we sold it for $96,760, I believe, right? $96,760. Come on. $96,760. Don't freeze on me. $96,760. All right, it's going to freeze on me. You guys get a chance to breathe. $96,760. Oh, wrong one. I opened the wrong one. Uh-oh. Sorry about that. Need the ratios and the bonds. So 96,760, single yield to maturity approach, discounting all future cash flows at that single yield of 96%. Excuse me, of 9%. Sorry about that. Welcome back. Pick up where you left off. I would love to. Don't give me a black screen. All right, there we go. Okay, let's try another one. You ready? 138. Let's see what we got. Oh, we'll do 139. It's going to answer 2 for 1. Okay, they tell us we got a 12% annual coupon bond. Face 100, 4-year term. Market rate now is 10. Stop right there. So coupon. Oh, come on. What's going on? You guys set it up. You ready? Future value 100. Your coupon is at 12%, 100,000 times 12%. Your payment is 12,000. So we got a future value of 100,000. We got a payment, our coupon, 12%, annual pay, 12,000, 100,000 times that 12%. Our number of payments is 4. Our market rate now is 10%. Now forecast your answer to make sure you're not making a silly mistake. We know that the market is happy with 10. 10 is less than 12. So that means we're expecting a premium. A premium is really what? A built-in gain, folks. A premium from the perspective of the issuer. Whenever you see a premium from the perspective of the issuer, the borrower, that is a built-in gain. That's going to cause your interest expense to be less than your coupon paid. Your financing inflow is going to be greater than your financing outflow. Whereas from the perspective of the investor, this is a built-in loss, a built-in loss. Your interest income is going to be less than the coupon received. All righty. The price paid is greater than the face value. So folks, when you solve for present value, what do you get? 106,340. So again, in accounting, folks, in accounting, the cash proceeds, your financing inflow, 106,340. Yet what do we repay someday? Face value. Your initial carrying value has got to equal your selling price. That's your initial carrying value. It's got to equal your selling price. So folks, this is an unrealized gain, an unamortized premium of 6,340. Unrecorded, unamortized premium is an unrecorded gain. That's all it is. All righty. Little by little, as we amortize that gain, the carrying value little by little will get pulled down towards par over the life of the bond. So how do we calculate interest expense again? Using the effective interest method, which is required under IFRS and preferred under US GAAP. The effective interest method. You take that initial carrying value, 106,340, you multiply it by the yield to maturity, carrying value beginning of the year, times that yield to maturity, 10%, 10,634. Therein lies your interest expense, which is greater than our coupon paid, less than our coupon paid of 12,000. What's the difference? 1,366. The carrying value is going to get pulled down by 1,366. What were they looking for in this question? What's the change in the liability? Not year 1, but year 2. 1,366 is the change in liability end of year 1. The carrying value is now 104,974. Multiply that by your yield to maturity again, 10%. 10,497. Notice as your carrying value gets pulled down, our interest expense gets pulled down with it. Constant yield, but the dollar amount's getting pulled down. Coupon paid, no change. That's constant, 12,000. What's the difference? $1,503. Now the carrying value will be pulled down again by 1,503. So in year 2, the reduction to the liability is 1,503. Read carefully. What year are they asking us about? Okay. Let's try another one. Straight line method amortization. You know it's US GAAP only. US GAAP only. They prefer the effective interest method, but straight line method is allowed under US GAAP so long as the dollar amount is not significantly different. All righty. Normally that's the case with relatively short-term debt. So in this question again, same facts. We took in $106,340, yet the face value is 100. This is a built-in gain for the issuer. Unamortized premium. Okay, what you do is with the straight line method, you say, okay, let me take the face value of this debt, 100,000, multiply it by the coupon. the coupon rate was 12%. So your coupon, $12,000. Remember, anytime a bond is issued at a premium, your interest expense has got to be less than the coupon paid. So the question becomes, with the straight line method, that $6,340, that built-in that gain for the issuer, we're going to spread it out over the life of the bond evenly, divided by 4 years. You get $1,585. So what we'll do is our interest expense every year will be $12,000 minus the amortization of that gain. Our interest expense every year will be only $10,415, all 4 years, less than the coupon paid of $12,000. IFRS does not allow this. US GAAP prefers that you don't do it. But if it's relatively short-term debt, not a big deal. The numbers are immaterially different, so you can go ahead and do it. So your interest expense all 4 years would be constant. All 4 years would be constant, $10,415. Okay, $10,415. Beautiful. You guys loving this, Sam? How you liking this? Any questions for me, Sam, as we're going along? Any questions?
So far, Peter, no, we've been able to take them as they've been coming up.
All right. All right. If anything big comes up, let me know.
We will do that.
All right, sweet. 146. Take a picture of it, and then we'll do it together. All righty. What is the difference between the book value of debt versus fair market value of debt? You ready? Both are on the books at the sum of the present value of the future cash flows. Both are on the books at the sum of the present value of the future cash flows. So what's the difference? The book value of the debt uses yield to maturity, market rate, at issuance as the discount rate. Market value uses the current market rate as the discount rate. That is the difference between the book value of debt versus the fair market value of debt. What discount rate you use. It's still the sum of the present value of the future cash flows. It's just a matter of what discount rate you use. So look at this question. We got company A, 10-year maturity, issued 5 years ago when market rates were 10. Company B issues 5-year bonds. All right, so company A issued 10-year bonds 5 years ago. So the remaining term is 5 years. Company B issues 5-year bonds right now, 5-year bonds today. All righty. Now, with company A, they issued those bonds when rates were 10%. Rates today have dropped to 5%. What's going to happen to the fair market value of company A's debt? Rates go down, fair market value is going to go in what direction? Up. The fair market value of company A's debt is going to be greater than company B. Now, is that an advantage or a disadvantage? Well, for company A, as rates go down, fair market value of your liabilities goes up. That means the fair market value of your equity is going in what direction? Down. That is bad news. If they were to mark the liability using current interest rates, now remember, book value, you would continue to use the 10%. The 5% is only relevant if you want to mark it to market value. If they marked it to market value, company A would not be better off. Okay, company A is not better off. Company B is better off because the true value of its obligations is going to be less than. Well, now take a look at this. Given that the book value of these bonds, their related liabilities, is identical, so the book value of A and B, let's just say the book value of A, book value of B, let's say it's both $1 million, the book value, okay? Since company B just issued the bonds, the book value equals the fair market value for company B because they just issued the bonds. The discount rate is 5%, whether it's book value or fair market value. Whereas for company A, since rates went down, well, if the book value was $1 million, we know that the fair market value for A is now going to be well above $1 million, given that rates went down. Okay, so company B will be better off. All righty, because the true value, the fair market value, would be lower. What's wrong with choice C? The economic value of company B's liabilities is lower than their book value? No. Company B, it's the same. The bonds were just issued on date. Bond issued, book value is going to equal fair market value. All righty. Now, when rates go up, we know the fair market value is going to go down. The question is by how much? How sensitive is the company's fair market value? How sensitive? What do we call that? Duration, a measure of sensitivity. When rates go up, fair market value is going to come down, but the question is by how much? All righty, that's the concept of duration. All righty, so that's the concept of duration and fixed income. Okay, let's see. We got another good bond question here that I could beat you up with. Yeah. 151, let's go. We are on a roll, baby. We are on our way to a CFA. I'm feeling it. You ready to take a picture? 151. All righty. Relatively short set of facts. Let's take it from the top. Relatively short, 3 or 4 lines. Let's see what we got. We got $1 million 5-year bonds. Market rate was 5. The coupon rate was 4. Stop right there. You ready? The market rate is 4. The coupon rate was what? 5. So my market rate, I'm sorry, I got that backwards. My market rate was 5. My coupon is 4. So the market wants a rate higher than the coupon we offered. Price should be discounted. All righty, so I set it up. My financing inflow is going to be less than my financing outflow. They gave me the sale proceeds, $956,705. Face value, $1 million. So folks, your financing inflow is less than your financing outflow. Initial carrying value, $956,705. The difference between the $1 million and the $956,705, $43,295. That is the unamortized discount. As we subtract a smaller and smaller number, carrying value will get pulled up towards par over time. Now, as compared to the straight line method, if the company uses the effective interest method to amortize the discount, what will happen to the profitability in 2012? Well, let's see. Straight line method, we would take the discount, divide it by 5. We would amortize $8,659 per year, okay, of that discount. Remember, anytime a bond is issued at a discount, your interest expense has got to be greater than your coupon paid. So with the straight line method, what's going to be our coupon? Well, the face value is $1 million. The coupon is 4%. $1 million times 4%, $40,000. My coupon paid, $1 million times 4%. It's annual pay. All right, so your interest expense under the straight line method would be $40,000 plus $8,659. $48,659. That would be your interest expense, straight line method. Now, what about effective interest? What if we did effective interest? Then it would be your initial carrying value, $956,705. Your initial carrying value times your market rate, not today's market rate, but your market rate at issuance. The market rate at issuance was 5%. $956,705 times 5%, $47,835. $47,835. That would be your interest expense under the effective interest method. Your interest expense is lower, so your profit is higher. If we were doing the effective interest method, your interest expense is lower, your profit is higher. Now be careful. You ready? That's in the early years. But remember, little by little, as the carrying value gets pulled up towards par, your interest expense is going to get pulled up. It's going to be pulled up. It's going to get higher. So in the early years, you're going to benefit. Your interest expense will be lower. But in the later years, your interest expense will be higher. Total interest expense will eventually be the same. Total interest expense and profitability at the end of term, the term of this bond is going to be the same. What's the difference? The timing of the expense, okay? All righty. Now, let's talk about adjusting financial statements. 154. A company is following US GAAP. They issued a zero coupon bond. You ready? A zero coupon bond. There's no coupon paid. No cash outflow from operations. So it makes it appear as though your debt has a zero cost. But we know that's not the case, folks. What if we have a $1,000 bond? Okay, a $1,000 bond. Let's say we have a 10-year term. Market rate is 6%. The coupon is zero. So the market rate is 6%. The coupon is zero. All right, and let's say the term is 10 years. How would we get the selling price of this bond? Well, you would take your future value, discounted back. What's our market rate? Our discount rate, 6%, raised to 10. What would be the selling price of this bond? We'll take that 1,000. You ready? Do it with me. Take that 1,000, discounted back at 6%, raised to 10. $558. That would be your present value. That would be the selling price, your initial carrying value. Now, you would take that initial carrying value, 558, multiply it by your market rate. What's our market rate? 6%. What is 558 times 6%? Let's round it up to approximately $34. Your interest expense rounded up greater than your coupon paid of zero. You see, the problem is cash flow from operations is an incredibly important number because that's our starting point for calculating free cash flow to equity and free cash flow to the firm. So folks, if you don't want a misleading valuation, how should you adjust the financial statements? You should say, even though there's a zero coupon paid, the interest expense is actually what? 34. So we should take our cash flow from operations and subtract 34 and use that adjusted cash flow when we calculate our free cash flow to the firm, free cash flow to equity, because a zero coupon bond makes it appear as though the bond has no cost. Obviously it does. The cost is represented by the yield, not the coupon. All righty. And then every single year, as we amortize that discount, carrying value goes up, your interest expense will go up. The market rate stays the same. All right, so we got to adjust those financial statements before we assess value. All right, so I know you're excited. You ready? Let's do another one, and then we will do leases. Last one for the bonds, and then we're moving on to leases. You ready? Take a second, set it up. 162, take a picture, set it up. All righty. You ready? They want the carrying value of the bond at December 31st, 2016. When was the bond issued? January 1, 2014, 10-year. Folks, it's a semi-annual coupon. So, folks, the original term was 10 years. What's the time elapsed? All of 2014, all of 2015, all of 2016. So the time elapsed is 3 years. So what is our remaining term to maturity? Our remaining term to maturity is 7 years. How many coupons do we have left? 14 coupons remaining. All righty. Now they tell me the bond has a face value of $7 million. We got a coupon of 10%. You ready? What was the market rate of this bond? Well, the market rate of this bond, the market demanded a rate higher than 10, so the price was discounted. All righty, the price was discounted. Now, I don't want to go through that entire amortization schedule. I just want the value of the bond with 7 years remaining to maturity, 14 coupons remaining. So what do? I take my face value, my future value, $7 million. What's my payment? Well, my coupon, 10%. Take your $7 million times your 10%, but now you got to remember to divide by 2. Semi-annual pay, so your payment is $350. Our remaining term, 7 years, 2 coupon payments per year, 14. You got to have consistency with the payment and the term, right? What's our market rate here? 12%, but divided by 2, 6% yield. Okay, so it's semi-annual. So you got to make an adjustment to your payment, your term, and your yield. So what is the present value of this bond? It better be discounted, or we did something wrong. $6,349,351. Correct answer, choice A. You know the wrong answer, B, is going to do what? Annual pay. Annual pay. There will be an answer choice, annual pay. All right, but we're ready for that. Okay. Now let's see. You know what? I want to do 163. Again, showing you how these math-intensive questions can sometimes be theory-based. You know, take a look at this. You ready? A firm incurs issuance costs, bond issue costs. US GAAP and IFRS now have the same rule dealing with bond issue costs, okay? Bond issue costs. They tell me the bond was issued for 97% of par. $1 million times 97% of par, $970,000. What do they have to pay back someday? $1 million. But we have bond issue costs. US GAAP and IFRS say we'll take the bond issue costs, reduce it from your net proceeds. So folks, our net proceeds are $960. What's got to be our initial carrying value? $960,000. Now we've got $40,000. 30,000 of that is unamortized discount. 30,000 of that is unamortized discount. 10,000 of that is bond issue costs. But either way, we're going to spread out those costs over the life of the bond. As we amortize that, what's going to happen to the carrying value of that bond? It's going to be pushed up towards par over time. So folks, the initial liability, US GAAP and IFRS, exactly the same, $960,000. Both US GAAP and IFRS are now on the same page, $960,000. Okay, now I'm ready for leases. Are you ready for leases? Leases, leases, US GAAP, IFRS, operating lease, financing lease. Let's do it. Let's jump ahead, 174. We're going to do some leases. Here we go. A lease question. You ready? Manufacturing company is leasing a machine. It's going to use for a 5-year project. Do they have to show a lease liability? Yes, they got to show a lease liability. Okay, the lease liability, US GAAP and IFRS. It is the present value of the lease obligation. Tell me the number of payments. Tell me the payment. Tell me the rate implicit in the lease. Now be careful with the payment. Is it coming at the end of each period? Do I want the present value of an ordinary annuity, or does the first payment begin today? Do I want the present value of an annuity due? All right, but tell me the number of payments, N. Tell me the payment. Tell me the rate implicit in the lease. And there's the present value of the lease obligation. Both US GAAP and IFRS. Present value of lease obligation goes up. Your liabilities go up. Your assets go up. Both US GAAP and IFRS. Okay? I don't care how you categorize the lease. It doesn't matter. Both US GAAP and IFRS, every time you lease, unless it's a really short-term lease, less than a year. Okay, if it's less than a year, then you don't have to record the present value of the lease obligation because it's so short-term, but that's a rare exception. So folks, today's rule, leases, doesn't matter if it's an operating lease or a financing lease, it does not matter. Under both US GAAP and IFRS, you are going to be recording present value of a lease obligation. All righty, let's try another one. 175. IFRS, lease accounting rules. A company leases an asset to a lessee will show on the statement a profit or loss. Folks, how do we account for a lease under IFRS? Whether it's an operating lease or a financing lease, it does not matter. How do we account for the lease under IFRS? Step number one. Step number one. Step number one, you're going to find the present value of the lease obligation, as I just showed you. Your number of payments, the size of your payment, the rate implicit in the lease, there's the present value of your lease obligation. That's going to make your assets go up. That's going to make your liabilities go up by the exact same amount. The present value of the lease obligation becomes an asset. We call it a right of use asset. Liabilities go up. All righty, so your assets go up, your liabilities go up by the exact same amount. Step one is complete. Step two, under IFRS, when you're a lessee, you take the present value of that lease obligation, divide it by the term. There's your depreciation. You take your lease payment, you take that lease payment, you have to allocate that between interest expense, the initial carrying value of the lease, times the rate implicit in the lease. The lease payment minus the interest expense, there's the principal reduction on the liability. So under IFRS, whether it's an operating lease or a financing lease, it doesn't matter. From the lessee's perspective, under IFRS, you always record depreciation expense and interest expense, period. Does not matter. You record depreciation as well as interest expense. All righty, so you will always record depreciation and interest expense. Okay, depreciation and interest on the income statement. The repayment of the lease liability, that reduces the carrying value of the liability. That's on the balance sheet. Okay, they're looking for P&L, the income statement. Okay, now, how do you know what an operating lease is? How do you know what an operating lease is? US GAAP and IFRS, the name they give the lease. Okay, the lessee, the lessor, same rules. Do we call it an operating lease or a financing lease? Okay, what do we call it? You ready? If you're a snob, we're going to capitalize the lease. What does the S stand for? If you're a snob, it's a financing lease. A snob, it's a financing lease, and I'll modify this in a second. You ready? The term. It used to be 75% or more of the useful life. The S stood for 75. It doesn't have to be exactly 75%. It just has to be for the majority. The term has got to be relatively long. Okay, used to be 75%. They did away with that. All right, but it's got to be a pretty long lease. a major part. A major part. All righty. So 75%, you know, and you meet any one of these, any one. But they did away with the 75%. They just said it's got to be a major part. But figure major part, you know, at least it could be 2/3, 3/4, but it used to be 75%. The present value of the lease obligation, it used to be greater than or equal to 90%. So that was the N in the SNOB acronym. They say, it doesn't even have to be 90%. Okay. It's just got to be substantially all, But that's a good guide. What do they mean by substantially all? I don't know, 90% or more. You know, could it be 88%, 89, 85? It's got to be substantial. The present value of the lease obligation's got to be 90% or more of the fair market value. Used to be the exact rule. Now they did away with the 75 and 90. They're a little bit more flexible, major part rather than 75, substantially all rather than exactly 90. Okay, do we transfer ownership? Do we have a transfer of ownership at the end of the lease? That's the O. Transfer of ownership at the end of the lease. Do we have a transfer of title? Okay, a transfer of ownership. That's the O. Does the lessee have a bargain purchase option? The option to buy it at the end of the lease well below the fair market value. So they could buy it well below the fair market value. Okay. And now the last test, the asset has to have no alternative use to the lessor. All right, so the asset is unique for this buyer, for this lessee. It's unique. It's for this lessee only. Okay, so you meet any one of those and it's a financing lease. Okay, if none of the criteria or if none of those are met, then we call it an operating lease. Under IFRS, it does not matter whether it's an operating lease or a financing lease. Under IFRS, the accounting is exactly the same for the lessee. It's exactly the same for the lessee. But under US GAAP, that's not the case. Under US GAAP, the way we account for an operating lease is different from the way we account for a financing lease. Okay, under US GAAP, we still record an asset and a liability. That doesn't change. The income statement accounting, though, is different depending upon whether it's an operating lease or a financing lease. So the easiest way is you snob you. If you a snob, you got to book it as a financing lease. It's unique. Or the term, it doesn't have to be exactly 75. It could be 2/3. It could be 78, 80, whatever. But it used to be 75. Present value of the lease obligation's got to be substantially all of the fair market value. It used to be 90. It could be 85. It's just got to be substantial. But 90% used to be the guideline. Or we transfer ownership or bargain purchase option. Any one of those, it's an operating lease. US GAAP, that does not, the initial was still going to record an asset and liability, but the income statement accounting is different, as you're going to see. Okay, and I'll illustrate that in a second. All righty. Now, let's try another one. You ready? 176. You ready? Under US GAAP, lessee lease accounting rules, a company leasing an asset to use. If it's a financing lease, same accounting as IFRS. You record depreciation and interest expense. Exact same thing as IFRS, you record depreciation and interest. Okay, so US GAAP, if it's a financing lease, you snob you meet any one of those, you snob, you record depreciation and interest expense. If you not a snob, operating lease, then you only record what's called lease expense. No depreciation, you record lease expense. No depreciation, no interest. You only record lease expense. That's it. And the lease expense is the same thing as the lease payment. And the lease expense is the same as the lease payment. All righty. So US GAAP, the label you put on it is important. IFRS, it's not important. All righty. Got a frozen computer. Love it. Let's try another one. I shouldn't have saved it. Now it's going to take too long to close. Of course, Word is not responding. Of course it's not. All right, we're going to do another one. While we're waiting for this to unfreeze, what's very important is how you classify that cash payment. Okay, how you classify that cash payment is extremely important. Okay, under US GAAP, that entire lease payment, if it's an operating lease, what we just doing? Ratios, let me just open that up again. Under US GAAP, if it's an operating lease, if it's classified as an operating lease, then 100% of the payment, 100% of that payment is going to be operating outflow. Okay, 100% of that payment will be operating outflow. Under IFRS, if you split the payment, the interest is operating outflow, the repayment of principal, that'll be financing outflow. Okay, financing outflow. All right, so let's try 177. You ready? We got a company that engages in the activity of the use of leased assets. They've categorized the leases as operating leases because the lessor retains most of the benefits and risks relating to the assets. Okay, so that's another way to determine that it's an operating lease. It's short term, okay, not less than a year, but the term of the lease is not the majority substantial. The present value of the lease obligation is not substantial. It's well below 75% term, well below 90% of the fair market value. All righty, so under US GAAP, the lease payment, that's your expense on the income statement, the lease payment. It's called lease payment. That's your expense on the income statement. And the lease payment, that's all operating outflow. Now, because that's all operating outflow, your cash flow from operations is otherwise lower. So that's a disadvantage of having an operating lease. That's the disadvantage of it being an operating lease. Okay, it's all operating outflow. So your cash flow from operations are relatively lower than if it were a financing lease. With a financing lease, you've got interest expense and depreciation. And then on the statement of cash flow, the interest portion is cash outflow from operations. Only the interest portion, only the interest is operating outflow. So relatively speaking, your cash flow from operations is higher. The principal repayment, that's financing outflow. So relatively speaking, your cash flow from financing is lower, but you're always worried about that operating cash flow number because that's your starting point for free cash flow and valuation. All righty. So they want to know which of the following is most accurate. I'm looking for a true statement. You ready? A true statement. Due to this being an operating lease, there is no requirement to show the leased asset on the balance sheet. Wrong. On the balance sheet, the present value of the lease obligation is still an asset and a liability. So my friends who have been out of school a while, the leasing rules changed, I don't know, about 5 years ago. Operating leases used to be called off-balance sheet financing because you didn't have to record the asset and liability. No longer. Under the new leasing standard, US GAAP and IFRS, even if it's an operating lease, you're still recording the present value of the lease obligations as an asset and a liability. So that's false. The cash payment for the lease will be shown as cash flow from operations. That's the true statement and correct. What's wrong with C? Depreciation is going to be shown, not if it's an operating lease. All we're going to show is lease payment. It's going to be called lease expense. All righty. Let's try another one. When a lease is classified as a financing lease, you ready? The long-lived asset, both US GAAP and IFRS, the rules are the same. Both US and IFRS, the rules are the same now. We record depreciation and interest expense. The asset is recognized and depreciated on the lessee's books. It's as if they bought it. It's recorded on the lessee's books, not the lessor. The lessor removes, with the lessor, which I haven't spoken about yet, with the lessor, if it's an operating lease, they keep the asset on the books. They keep asset on their books. They keep the asset on their books. The lessor records depreciation, not the lessee. Okay, the lessor records depreciation. Okay, and the lease payment received. Lease payment received, that's rental income. Rental income. If it's a financing lease, again, this is from the perspective of the lessor. The lessor removes asset from their books, removes the asset. Lessor records, the lessor is going to record a lease receivable equal to the present value of the payments that they're going to receive. Okay, they're going to record lease receivable. And then they're going to record potentially profit on sale, and interest income. All right, that's from the perspective of the lessor. Then the categorizing as operating or financing is very important. All righty. But if it's a financing lease, the lessor, if it's a financing lease, they remove the asset. If they remove the asset, they stop depreciating it. No depreciation. So that's incorrect. Who's going to record depreciation? The lessee. Okay, the lessee records depreciation, both US GAAP and IFRS. If it's a financing lease, lessee records depreciation. Okay. You ready? Let's do one with numbers. Let me get one here. Yeah, here we go. There we go. Let's try 181. Let's bang out one with numbers. All righty. I'm going to work this one twice. I'm going to show you how to do it as an operating lease, which is only relevant under US GAAP. Okay. So let's do that first. So you not a snob. We do not meet any one of the 5 criteria of you snob. Okay, so we do not meet any 5 of those criteria. As soon as you see operating lease and it's US GAAP, no depreciation, no interest expense. Let me show you how to account for this. You ready? Step number 1, the payment. They tell me $5,000. When they say nothing, ordinary annuity, unless they say specifically the first payment is made immediately, ordinary annuity. My number of payments, 5 years. The rate implicit in the lease, 8%. What is the present value of this lease obligation? $19,964. So that means on the balance sheet, assets go up, $19,964. Liabilities go up, $19,964. Okay, and this is exactly the same. This initial accounting is exactly the same, whether it's an operating lease or a financing lease. You still have to record the present value of the lease obligation as both an asset and a liability. Step 2, it's an operating lease. So this is the US GAAP rule operating lease. You ready? On the income statement, the $5,000 payment, that's lease expense. It's like rent. It's an operating expense, 100% operating expense. It's like rent. Okay, lease expense, it's like rent, 100% operating expense on the income statement. There's no depreciation. There's no interest expense. No depreciation, no interest expense. 100% lease expense. So the operating expense is 5,000. The non-operating, the portion that is interest, is 0. All righty. Step 3, operating lease, US GAAP. What do you do next? You ready? What do you do next? We don't record depreciation. We don't record interest, but we do have to do this journal entry as well under US GAAP. You ready? We still have to do this next step. So we take that payment of $5,000 and I say, okay, how much of that would have been towards interest? Would have been carrying value of the liability, $19,964 times the rate implicit in the lease, 8%, $1,597. That is not interest expense though. That is not interest expense. But what we do is we take that $5,000 payment, subtract out that $1,597, and we record amortization on the asset of $3,403. So as an operating lease, what would happen is the carrying value of the asset would go down by $3,403. That would be called amortization, not depreciation, not depreciation. And the carrying value of the liability would go down by $3,403. That's what you would do each and every year. Okay. And as the carrying value of the liability goes down, the portion allocated towards what would have been interest goes down. And the portion allocated towards what would have been principal goes up. That's an operating lease. Okay, now let me show you what we would do. IFRS all the time, IFRS, operating lease or capital lease, and then US GAAP if they classify it as a financing lease. How would things differ? Well, the way things would differ is we would take that $19,964 asset, we would divide it by the term of the lease, 5 years. We would record depreciation of $3,993. And we would record interest expense. Interest expense of $1,597. The carrying value of the liability times the rate, $1,597, that's interest expense. So your total expenses, $5,589. So for a financing lease, your total expenses year 1, $5,589. All righty. That's if it's a financing lease. Now notice that's greater than operating lease US GAAP, only $5,000, the payment. So is this an advantage or a disadvantage? Well, if your expenses are higher, then your profit is going to be lower in the early years. In the early years of that lease, your expense is higher, so your profit is lower when it's categorized as a financing lease. All righty, in the early years. But in the later years, while the depreciation does not change, the interest expense will decline as the carrying value of the liability goes down. So in the later years, the expense is lower, the profit is higher. Eventually, the total expense will be the same. Total expenses and profit will be the same. And what's it going to be? The payment, $5,000 times the number of payments. What was the term of this lease? In this example, it was 5 years. Eventually, both methods, $25,000 in total expenses. It's just a matter of allocating it to time periods. Okay, to time periods. The other major issue is, oh, come on, man, you froze on me again? No. All right, we got it. So the other major issue is, folks, under a financing lease, only the depreciation is an operating expense. So under a financing lease, your operating expenses, the depreciation only, is going to be less than your operating expenses under an operating lease, which is the entire payment, $5,000. So your depreciation will always be lower. So this is an advantage to a financing lease. If your operating expenses are lower, your operating profit is going to be higher under a financing lease because your operating expenses are lower because interest is a non-operating expense, okay? Non-operating. Woo, baby, I feel like I'm giving birth to a level 2 candidate here. All right, let's see what else we got. All right, you know what? We got to move on, folks. We got to move on. Let's do earnings per share. Earnings per share. You guys ready? Sam, talk to me, baby. Talk to me, baby. How we doing on time? What do we got? 3 hours left? Sam.
At least 3. At least.
Beautiful, beautiful. That's what I wanted to hear. Okay, folks. So what I'm going to do now is we're going to do some earnings per share and then some statement of cash flow, don't you know? All righty. So some earnings per share and statement of cash flow. I got that on a separate PowerPoint, which is going to be just as pain in the butt as this one, but we like it. We like no pain, no gain. I'm feeling the, bring the pain, bring the pain. All right, so here we go. So earnings per share, there we go. No, I want the earnings per share and cash flow answers because that's clean. Where's the earnings per share and cash flow answers? Nope, 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 nope. Nope, nope, nope. There we go. I got it. I got it. All right. So, okay. Let's start here. I want to beat you up here. You ready? I want to beat you up, beat you up, beat you up. No, I'm going to jump all the way down. Number 40, baby. Number 40. No easy ones for us, Sam. No easy. We like hard stuff. By the way, folks, just as an FYI, our 2-day boot camp. We will not have these computer issues. I'm very, very sorry. My Microsoft whatever PowerPoint updated gave me all screwed up today. But I want it clean. Yeah. So it's all problem solving. It's using the rules. Using the problems to illustrate the application of those rules. Okay, that's what it's all about at this stage of the game. So, yeah, we don't want to do any, yeah, all right. So, yeah, we don't want, and hold on, I'm gonna, hold up. Hide the ink, you bet it. Delete all ink on the document. There we go. All right, so here we go. They want basic EPS diluted. What kind of companies have to do diluted EPS? Who has to do diluted? Diluted, that is a rule of conservatism. Diluted is always less than or equal to your basic EPS. Who always has to do diluted? Companies with a complex capital structure. You either have convertible bonds, convertible preferred equity, or outstanding options or warrants. If you have any one of those, convertible bonds, convertible preferred equity, or options or warrants, you got a complex capital structure, you have to do diluted EPS. But your starting point, folks, is always basic. All right, so we always start with basic. How do we do basic? Net income minus preferred dividends divided by your weighted average common shares outstanding. All right, so let's see what we got. You ready? We write down our formula, now we plug it in. Net income, got it, $2,440,000. So I plug it in, $2,440,000, drop the zeros if you can. Preferred stock, $850,000. What rate of return are they getting? 12%. So what's the preferred dividends? $102,000, $102,000. Dividends paid to common stockholders, distractor information, get it out of there, distractor. This net income minus preferred dividends is also known as what? Income available to common stockholders. That is also known as income available to common stockholders. All righty, my income available to my common stockholders, 2338, and I should be dropping the zeros consistently, 2440 minus 102. Weighted average common shares outstanding, I like it, it's given information, 2 million. So 2338 divided by 2 million, what is my basic EPS? 1.169. 1.169, closest to 117. Hey, the answer's got to be B. We don't even have to do diluted, but of course we're going to do diluted. You ready? The company also has $100,000 par, 8%. As soon as you see the word convertible, what do you think? Complex. That means we got to do what? Diluted EPS. All righty. When you have convertible bonds, what do? You take that income available to common stockholders from step 1, 2,338,000, and you're going to add your saved interest expense net of tax times 1 minus the tax rate. You are going to divide that by your weighted average common shares outstanding, 2 million, plus the number of common shares issued if they convert. It's the if converted method, if they convert it into equity. You ready? So it's $100,000 par value, 8% convertible bonds. So take the 100,000 times 8%. 100,000 times 8% times 8%. Okay, that's our interest expense we're going to save, but we're going to save it net of tax. So you got to multiply this by 1 minus the tax rate. Tax rate is 35%. So 8,000 times 1 minus the tax rate, that's $5,200 we're going to save. That's the good news. So the saved interest expense, 5.2. $100,000 of debt times the interest rate of 8%. By the way, for these questions, your coupon and your yield to maturity are one and the same, such that your coupon represents your cost of borrowing. Okay? 8,000 times 1 minus the tax rate, we add back not 5,200, but 5.2. Weighted average common shares outstanding, 2 million. How many shares do we have to give out? 20,000 shares. All righty, so that's 2 million plus 20, dropping the zeros. So 2338 income available to common stockholders. Add your saved interest expense net of tax, divided by your weighted average common shares outstanding plus the number of shares issued. What do we get? 1.16, and whoop, there it is. All right, so that just illustrated convertible bonds. Okay, let's try another one. Easy one now, you ready? It says medium, this is easy. Come on, man. Which of the following is least likely? Which of these is not dilutive? Preferred stock is not dilutive. Options are, convertible bonds are. So the correct answer is preferred shares. That is not dilutive. For it to be dilutive, folks, what word has to be there before the word preferred? What's got to be there? Convertible. If it's convertible preferred, then it's potentially dilutive. Without the word convertible, then it is not dilutive. Okay, give you a chance, set up the next one, take a picture. Same thing, start with the question stem. I got to do basic and diluted. We always start with basic. What's your formula? Write it down. Net income minus preferred dividends divided by your weighted average common shares outstanding. My net income, 2,360,000. Drop those zeros. 2,360 minus preferred dividends, 500,000. I got 10% preferred. Well, that's $50,000 in preferred dividends. Dropping the zeros, 50. Dividends paid to common stockholders. Distractor information. Weighted average common shares outstanding, 500. So the income available to common stockholders, 2272.50, 2272.5, divided by weighted average common shares outstanding. If they give you, folks, read carefully. If they've given you income available to common stockholders, do not subtract out preferred dividends. Income available to common stockholders is already net, All righty. Now, the company also has 500. Oh no, look what happens. You ready? I got convertible and I got more preferred stock. So convertible, we jumped the gun. My preferred dividends are not just 50. There's more preferred stock, but these are convertible, giving us a complex capital structure. All righty. So let me get rid of that number. You ready? My preferred dividends are not just 50. On the convertible preferred stock, we have 500 shares outstanding, which pay a dividend of $75 a share. So 500 convertible preferred shares times a dividend of $75 per share, that's 37,500. So the dividends are not just 50, they're 50 on the non-convertible, and 37.5 on the convertible preferred stock. So now I've got my numerator. 2 classes of preferred stock. Total preferred dividends are 87.5, giving me income available to common stockholders of 2272.5. That's the key to getting this question correct. We have 2 types of preferred stock. One is non-convertible, one is convertible. All right, 2272.5 divided by your weighted average common shares outstanding of 500,000. Basic EPS 4.545. We know our answer's got to be B. Okay, now let's do step 2, diluted. What do we always start with? You always start with your income available to common stockholders divided by your weighted average common shares outstanding plus the number of common shares if converted, if that conversion option is exercised. Okay, so the income available, 2272.5. There's only one class of convertible. So what are we adding back to the numerator? The saved preferred dividends. You add back to your numerator your saved preferred dividends in their entirety. You ignore, come on, man, don't do that. You add back your saved, come on. All right, David, no, there we go. Add your saved preferred, come on, man. Hold on. Got to reload this. Hold on. Uh-oh. So we only add back the 37.5 to the numerator. Okay, that's all we're adding back is the 37.5. That's it. Okay, so just the 37.5, 9 hours ago. What the heck? So we're only adding back the 37.5 to that numerator. All righty, just the convertible preferred. And then how many shares are going to be issued? Well, they tell us each convertible preferred can be converted into 50 common shares. 50 common shares. Question 42. Jump ahead here. Question 42. Hang on, we're getting there. Gives you a little chance to breathe. All righty. So, here we go. Okay, the income available to common stockholders, we're only adding back. Now, folks, when you add back your saved preferred dividends, you ignore taxes. Dividends are not tax deductible. So we add back the 37.5. Okay, 37.5. And now our weighted average common shares outstanding was 500. Our weighted average common shares outstanding was 500. Now the question becomes, those 500 convertible preferred shares can be converted into 50 common shares. So 500 times 50 common shares. So how many new partners would we have? Well, 500 times 50, that would be 25,000 new partners. So to my denominator, I'm adding 25. All righty, 25,000, dropping the zeros, 25. So save preferred dividends, ignore taxes because dividends are not tax deductible. And then 25 new partners, 25,000 dropping the zero. So that gets us diluted EPS 4.4. All righty, 4.4. Cool. All right. Now, what about that weighted average common shares outstanding? That could be a question unto itself. I like this question. You ready? Check this out. This question just wants to know, you ready? What's your basic EPS? That's all they want. They just want the basic EPS in this question. Okay, basic EPS. Okay, so my earnings per share, net income, minus preferred dividends. Now we're going to focus in on how to calculate that denominator if it's not given information. So they tell me we've got net income of $3,340,000, $3,340,000. I see no preferred stock, therefore there's no preferred dividends. Now the question becomes weighted average common shares outstanding. You ready? The very first thing you do is look for stock splits or stock dividends. Stock splits and stock dividends, we always deal with retroactively, folks. We always deal with those retroactively, stock dividends and stock splits. We pretend as though those happened at the beginning of the year. Now be mindful, what's the beginning of the year here? We're a calendar year. So 2 million shares, okay, January 1. The split happened March 1st. The dividend happened October 31st. We have shares issued July 31, shares repurchased on December 1st. There's a lot of ways to do this. Speed is always secondary to accuracy, as you know. So let me set it up for you. This is the way I would do it. You ready? January 1, I had 2 million shares outstanding. Okay. When was my stock split? March 1st, I had a split. Okay. March 1st, I had a split. So January 1st, we got to retroactively adjust. It was a 3-for-2 split. 3-for-2 split. And then on October 31st, 3-for-2 split. And then on October 31st, we had the stock dividend. What was the stock dividend? It was a 5% stock dividend. So you're going to have whatever you had, 100 plus that 5%. So we multiply by 1.05 for the 5% stock dividend. So folks, I'm pretending my adjusted balance, I'm pretending that I started with 3,150,000 shares, adjusting for the stock split and the stock dividend. Got it? Okay, what was the next event to happen other than the stock split or the stock dividend? On July 31st, we issued 200,000 shares. Okay, now that's after the stock split, but that's before the stock dividend. So I skip the stock split because July 31st is after that, but the stock dividend was October 31st. So all events that happened prior to that stock dividend have to be retroactively adjusted. So I retroactively adjust and say, nah, I didn't issue 200,000 shares. I take 200, multiply it by 1.05. I'm going to pretend as though I issued 210. Now I've got a balance of 3,360,000. What was the next event to happen? December 1st, I repurchased 100,000 shares. Now, December 1st is after the stock split, so I ignore it, and it's after the stock dividend of October 31st. So I repurchased 100,000, gets me a balance of 3,260,000. So I have three balances that I need to wait. Now I'm going to pretend I had that 3,150,000 outstanding from January 1 to July 31st. That is 7 months. Then I'm going to pretend I had the 3,360,000 outstanding from July 31st to December 1st. That's how many months? 4 months. And then the 3,260,000 I had from December 1st to the end of the year, December 31st, that's 1 month. So I weight each of those balances, ignoring the split in the dividend because we've already dealt with that retroactively. So 3,150,000 times 7/12, 1837.5 weighted. 3,360 times 4/12, 1120. 3,260 times 1/12, 271.67. My weighted average common shares outstanding, 3229.17. 3229.17. It doesn't get any harder than this, folks. We gave you a stock split. We gave you a stock dividend. Any event that happens prior to that date, January 1 has to be adjusted for both of those because that precedes both the split and the dividend. The stock issuance only has to be adjusted for the dividend because July 31st was after the split. The repurchase of 100,000 doesn't have to be adjusted for either the split or the dividend because it happened after both events. All righty, now pop that in your dividend, 3229.17, 3229.17. So my basic EPS, 3340 divided by that 3229.17, 1.034. Correct answer, choice A. All right, that's about as hard as that can get. Oh, the next one says hard. You know I'm going to do it. You see how we break out our questions for you folks? Isn't that so helpful, right? See where that level of difficulty is? All right, they tell us. A lot of facts here. Assume there are no other potentially dilutive securities. What's the diluted EPS under the Treasury stock method? You use the Treasury stock method whenever you have options or warrants. Okay? Options or warrants are dilutive only if the average price is greater than the strike price. Otherwise, you could ignore the options or warrants. All right. So let's do our basic EPS first. Basic net income minus preferred dividends divided by my weighted average common shares outstanding. In this example, they tell me I got net income, 4 million. Plug and go. Any preferred stock? Nope. So my preferred dividends, 0. I don't see any preferred dividends. Weighted average common shares outstanding. At the beginning of the year, the company had 500,000 common shares. Absent any other information, if there's no other changes, then what's at the beginning has to be at the end, thus at the average. The beginning is the average if there are no other events. So your basic EPS is $8. Okay, now they tell me we had 20. As soon as you see warrants, you immediately think what? Dilutive. Okay, potentially dilutive. It gives you a complex capital structure for sure. So let me see, what's the average price? The exercise price, the strike price is 60. Okay. The average market price during the year was 80. Is 80 greater than 60? You bet it is. Now, I want you all to pay attention to something very, very important in this question. You ready? When were those warrants issued? Well, they tell me at the beginning of the year, we had 500,000 common shares, and then we issued 20,000 warrants with an exercise price of 60 on July 1st of this year. July 1st of this year. That means they can only be outstanding 1/2 the year. You'll see why that's important in a second. All righty, so this is the way we're going to do it. First of all, we know it's dilutive. Okay, how much cash are we going to collect? You ready? 20,000 warrants times the strike price, the exercise price of $60 per share. How much cash are we going to collect? 1,200,000. And then we issue 20,000 shares. Okay, it's a 1-for-1. Where did that go? Uh-oh. Oh, there we go. Okay, each warrant entitles you to 1 share. So we issue 20. Oh, come on, man. Come on. I'm going to be a big baby. I'm going to cry. Why does my drawing function, anybody who's an expert in this, why does my drawing function just go away? I don't know. All right. Gotta close it, open it back up, take a breath. You guys keep working it. Working it. I will open it back up. So the company collects $1,200,000. They issue 15,000 shares. I mean 20,000 shares. Sorry about that. 20,000 shares. Okay, step 2. Why do they call it the treasury stock method? Because you're going to take that cash collected of $1.2 million and you're going to repurchase as many shares as you can, but you have to pay the average price. What was the average price? $80 per share. So you can only repurchase, we can repurchase 15,000 shares. So the net increase to the number of common shares outstanding, you're thinking is 5,000. But remember, when were the warrants issued? July 1. So folks, since they were only issued July 1, they can only be outstanding if they were all exercised on the day that they were issued. They can only be outstanding for half the year. So the actual increase to the denominator is 2,500, not 5,000. That's the key to getting this question correct. All righty. So the net income available to common stockholders was 4,000, dropping the zeros. The weighted average common shares outstanding, 500. With options and warrants, there is no increase to the numerator, nothing. But we just added 2,500 more, dropping the zeros, partners. So that makes our diluted EPS 796. 796. All righty. So the key to getting this question correct was to first realize warrants give you a complex capital structure. Since the average price was greater than the strike price, it's dilutive. The next step was to say, okay, we're going to issue the 20,000 shares. We'll collect $1.2 million. We can repurchase with $1.2 million at the average price, 15,000. The most common mistake is going to be to add 5,000 to the denominator. You don't. Because they were only issued July 1, you can't possibly have them outstanding all year. All righty. Okay. By the way, choice C, the wrong answer there, choice C would have had 5 in the denominator, 500 plus 5 as opposed to 2.5. Okay, let's see. Beep, bop, boop. All right, I think we're good with the EPS, man. I think we need to move on some statement of cash flow. What do you say? Cash flow, here we go. You know what? Let's do let's do cash flow. Unless I see a really hard one here, I'm just sliding through my notes. We covered all the basic issues, I believe. Yeah, let's go to statement of cash flow, folks. Statement of cash flow, here we go. Now, folks, we got started a little bit late because Sam couldn't get my computer to work for me, and Doug, these high-paid tech people making like $6 million a year, I have them log on. They're counting their money. You know, poor guy like me, just over here cranking out, couldn't get my computer to work. So we're going to go for about another half hour. You guys got a half hour in you? Sam, how you doing? Doug, everybody, you got a half hour in you? Chad, what do you say? All right, can we go for it? Let's go for it. So here we go, statement of cash flow. You ready? First of all, Cash flow from operating focuses in on the change in your operating assets and the change in your operating liabilities. Change in working capital is a proxy for that. Operating assets are all your current assets except cash and cash equivalent. Operating liabilities are anything that's non-interest bearing. Cash flow from investing focuses in on the change in your non-current assets. Cash flow from financing focuses in on financing liabilities, interest-bearing debt, and your own equity. And your own equity. How do you know it's interest-bearing debt? Look for the word bond or debt or negotiated or debenture or a mortgage or a line of credit. What do they all have in common? Interest bearing. I don't care if they're short term or they're long term. You see bond, debt, negotiated, debenture, mortgage, line of credit, you're thinking that's a financing liability. All righty, so total liabilities minus your financing liabilities, what you're left over with are your accruals, your non-interest bearing. Okay, with that little introduction, you ready? I don't care that they're only asking about transaction 3. We're going to do all 3 transactions. Here we go. Aquamarine is a manufacturer of perfumes. How nice. And has several retail outlets throughout Europe. The company uses IFRS, folks. Major differences between US GAAP and IFRS. All right, when it comes to the statement of cash flow, I'll review that with you in a second. All right, transaction number 1, they borrowed money from a bank for the purchase of inventory. Folks, when you borrow money from a bank, that is a financing inflow. When they buy inventory, that's an operating outflow. When they use whatever money they take, money's fungible, doesn't matter. It's an operating outflow when you buy inventory. Inventory is an operating asset. When you borrow money from a bank, negotiated debt, financing inflow. Okay, they made sales amounting to $990, assuming they're collected in cash. They're not, because they just told me 38 were on credit. So 990 minus 38. 952 would be operating inflow. All right. Transaction 3, which is what they're asking for. Invested excess cash amounting to $12,000 in securities classified, held for trading, also known today as amortized cost. Okay, that's known as amortized cost or a held for, that's called fair value through P&L, held for trading security. Okay, that 12,000, if it's classified as fair value through P&L trading security, that's operating outflow. Anything classified as held to maturity, that's also known as amortized cost. That 8,000 would be investing outflow. And anytime it's classified as fair value through OCI, or what they used to call an available for sale security, investing outflow. The only type of security that you buy that's an operating outflow is when it's classified as trading or fair value through P&L. All righty. So with and by the way, transaction number 4, you paid dividends of 130. When you pay dividends, US GAAP, financing outflow. IFRS could be financing outflow or operating outflow. And that's the same rule, okay? Presume IFRS uses the same rule as GAAP, US GAAP, unless you're told otherwise. Okay, unless you're told otherwise. All righty. So, but transaction number 3, you ready? We're not going to increase cash flow from investing. That's an investing outflow. We'll reduce. That's an investing outflow of 8,000. We're going to decrease operating by 12. That is the correct answer. Yes, by 12. we're going to decrease cash flow from investing by 8,000, not 20,000. So the correct answer, choice B. Okay, another major difference. Ready? Dividends received. US GAAP, that is always operating inflow. IFRS could be the same. Presume it's the same unless you're told otherwise. Or it could be investing inflow, a dividend received. Okay, and that's the same rule for interest received as well. Okay, same rule for interest received as well. All righty, now interest paid. I'm just going to use what I did here. Oh, I'll do it here. Interest paid. US GAAP, operating outflow, no option. IFRS, that could be operating outflow or financing outflow or financing. All righty. Again, on the exam, unless they tell you otherwise, presume US GAAP and IFRS are the same, unless they specifically tell you otherwise, okay? Because many times IFRS, even though it's an IFRS company, they're doing the same thing. So look at like easy questions like this. We say it's medium, it's easy. Interest paid, IFRS. Your correct answer would have been choice C if it were US GAAP. IFRS, you have an option, operating or financing. Okay, operating or financing. So you get lots of easy questions like that. Exam day, you better get it right and get it right quickly. Another easy one. You ready? Right on point. Dividends received. You ready? Operating or investing. US GAAP, it's got to be what? So that's IFRS. Okay, US GAAP, dividends received, we said was what? Operating inflow. US GAAP, that's operating inflow. Okay, so US GAAP, operating inflow. Okay, let's try another one. Let's get a little bit more challenging here. Get some math stuff, Let's see. Let's do, we'll find a nice hard one for you. Get you your money's worth. Now, again, folks, I'm saying again, you know, this is a free event monetarily, but certainly not free in terms of your time. So while I welcomed you here, I don't think I thanked you for spending your time with us tonight, but I do want to thank you. We certainly are looking to earn your business. That's why we do these free events. We believe it's incredibly important that you get the opportunity to see what the product is like before you buy it. And this is only part of our study plan. Folks, what we do is we give you the online text, or you can buy a hard copy. You know, you watch the lecture, there are recorded lectures, and then we have the Saturday live online that's a lot like this, problem solving. Really cool stuff. Okay. You ready? They want to know what's the cash flow from investing. As soon as you see that on the exam, change in non-current assets. Folks, when you issue long-term debt, that's financing inflow. You buy equipment, non-current asset, that's investing outflow. Equity earnings from an affiliate is non-cash. That is not on the statement of cash flow unless we adjust for it, indirect method, which I'll show you, but that's non-cash. All righty, so we have a $15 million outflow there. Okay, $15 million. So let's try another one. Let's do one. Oh, come on, man. You don't freeze on me again. 101. Because it's saving, that's why it's freezing on me. But let me just shut this down again. I'm going to do a really good comprehensive problem. I'm going to do a really, really good comprehensive problem. That's what I'm going to do. So we could cover a lot of ground with one question. Yeah, let's do that. Okay, let's do this one. Let's do 110. All righty. 110. Now I'm going to do a bunch of different things with this question. Even though they're looking for cash flow from financing, I also want to teach you how to do cash flow from operations, okay? So I'm going to use the same question to do cash flow from operations as well. All righty. Ready? There's two ways to do cash flow from operations. You can do what's called the direct method, cash collected from customers, plus, and I'm assuming US GAAP, okay, cash collected, interest, and dividends, minus cash paid, vendors, cash paid for all your operating expenses, cash paid for interest, cash paid for taxes. That's how you would get your cash flow from operations directly. You've got to know inside and out the indirect method as well. Okay, this is going to follow you to level 2. So very, very important. You start with net income. You add back depreciation and most amortization. You add back your losses because it's non-operating. You subtract out gains and amortization of a bond premium, folks. Amortization of a bond premium. You subtract out equity earnings from an affiliate because by definition, that is not cash received. You then subtract your change in operating assets, inverse relationship. You do the opposite. Add your change in operating liabilities, direct relationship. Cash flow from operations, same result, different format. All righty. Okay, cool. So let's see what we got. I want to take these facts and practice this. You ready? So net income, add back your depreciation, add back your losses, subtract out your gains, subtract your equity earnings, subtract your change in operating assets, add your change in operating liabilities, bang, cash flow from operations. There we go. Drop your zeros. How did I know to do the indirect method? Folks, when they give you information like net income, depreciation, they're telling you, do the indirect method. So I'm taking my net income, 1120. I'm adding back my depreciation of 27. I'm looking, do I have any losses? Nope. Do I have any gains? Nope. But it doesn't matter, folks. When you review your rule, review it in its entirety. All right, a decrease in inventory. You do the opposite. The minus sign means do the opposite. So I'm going to add that 13.8. That's an operating asset. An increase in taxes payable, that's an operating liabilities. You keep the sign, an increase, a plus 1.5. Issuance of common stock, that's a financing inflow. Dividends paid, US GAAP, financing outflow. Purchase of land, investing outflow. An investment in an associate. You bought stock in another company. You own at least 20, but not more than 50%, investing outflow. Purchased, held for trading, operating outflow, folks, operating outflow. That's a minus 7.2. That's an operating outflow. Sale of available for sale securities, that's an investing inflow. Why? Available for sale, and that's also known as what? Fair value through OCI. whereas held for trading is known as fair value through P&L. Cash flow from operations, 1155.1. Okay, now they just want my financing. There were only 2 financing activities. Issued common stock, a 60 inflow, and a payment of a dividend of 32.3. That's an outflow. Financing cash flow, a net inflow. A source of capital, 27.7. And there it is, 27.7. All righty, there's your cash flow from financing. Okay, let's choose another banger. Banging them out. Ooh, baby. I got a nice hard one for you. Here we go. Here we go. You ready? Let's jump ahead. We are going to go to number, let's see. Wow. Let's try another one here. Sorry about that, guys. Let's see. Nope, don't want that one. Let's do 115. Take a second, take a picture, and then we will do it together. All righty, so for 115, sorry, my pen's not working. Hold on. There we go. You ready? Operating cash flow. We got net income. 150. We have an increase in account receivable. This is too easy. But let's do it. I told you to do it, so let's do it. It said medium. I don't think it's medium. I think it's ridiculously easy. But nonetheless, you ready? Net income. Add back your depreciation. Add back your losses. Subtract your gains. Subtract your change in operating assets. Add your change in operating liabilities. Sometimes, folks, these two are given to you netted change in working capital. I'll show you that in a minute. All right, folks, we got net income of 150. I've got depreciation of 55. Don't have any losses, don't have any gains. We got an increase in an account receivable. So what do? Subtract that 30. I got a decrease in accounts payable. Keep the sign, subtract that 25. Okay, the plus sign means direct relationship. The negative sign means inverse relationship. So your 150, add your 55, subtract your 55, whoop, there it is, back to 150. All right, but that was way too easy. I don't even know how somebody said it. You kidding me, man? Let's do 114. I like 114. Start with your question stem. Take a picture. How do we get cash collected from customers? You need this. This is your starting point if you're going to do the direct method. You start with your net sales, folks, your net sales. $85 million, an inflow. Then you find for me your change in your accounts receivable. Folks, if accounts receivable goes up, that means you accrued for the sale. There's no cash. That's an outflow. If accounts receivable goes down, that's because cash is collected. That's an inflow. All righty. And I don't like the way I wrote that. I'm going to use the word increase, decrease. So if accounts receivable increases, that means you accrued for the sale. You've got no cash. But if accounts receivable decreases, that means you collected cash. That's an inflow. All righty. So my net sales were 85. What happened to my accounts receivable? Decrease. When accounts receivable goes down, cash goes up. That's an inflow of 5. So that's a 90 inflow. Here's a little trick for you. You ready? Whenever an asset goes up, think about being on the buy side. Cash goes down. Whenever an asset goes down, think about being on the sell side. cash goes up. Inverse relationship. Whenever a liability or equity goes up, you're borrowing. Cash goes up. Whenever a liability or equity goes down, you're repaying. Cash goes down. So assets, change in assets has an inverse relationship with change in cash. Change in debt and equity, direct relationship. All righty. Okay. Now let's see what we got. Let's see. All right, I like this one. Number 124, number 124. Here we go. Lots of given information. They want cash flow from operations. Okay, cash flow from operations. Okay, so they tell me dividends were paid, machinery was sold, whatever. Okay, nothing to do with cash flow from operations. I want to see, what did they give me? Well, they gave me an income statement. So folks, when you're given an income statement, what are we looking for on that income statement? If we're going to do indirect method, we're going to start with net income. Okay, net income. Add back our depreciation and most amortization. Add back your losses. Subtract your gains. Subtract your change in operating assets. Add your change in operating liabilities. Cash flow from operations. All righty, so my net income, 400. I'm looking for depreciation, 200. I'm looking for any losses, don't see it. I'm looking for the word gain. Now I do see a gain of 30. Subtract that gain. Why do we back out the gains and losses? By definition, folks, those are not part of your core business. That's non-operating. All righty, now I go to my balance sheet to find my change in my operating assets and my operating liabilities. So now we go to our balance sheet information, okay? Here's our balance sheet information. Here's our beginning. Here's our end. By the way, if we do our entire statement of cash flow correctly, which we're going to do with this problem, if we do our entire statement of cash flow correctly, you know what we've got to get? A plus 795. That's our check figure. And that would be backwards. Ending is the first column. Beginning of the year is the second column. Plus 795, that is the change. That's my check figure. When I'm done with my whole statement of cash flow, I better get a plus 795. Okay. Operating asset, accounts receivable. Inventory, operating asset. PP&E, that's investing because that's a non-current asset. Accounts payable, operating liability. A note, financing liability. Deferred taxes, operating. My own stock, financing. Retained earnings, financing. Okay, we're going to do this entire statement of cash flow. And let's see if we can't get a change in cash of 795. You ready? What was my change in my operating assets? Well, let's see. My accounts receivable ended at 260, started at 200, plus 60. Inventory started at 800, ended at 500, a minus 300. So folks, we do the opposite. We subtract the change. So we're going to subtract the 60. We're going to add the 300. So the increase in accounts receivable, we're going to subtract the 60. The decrease in inventory of 300, I'm going to add the 300. Change the sign. Operating liabilities. You ready? Now, what were my operating liabilities? I have two. Accounts payable. That's an operating liability. That went up by 20. Again, here's your ending. Here's your beginning, plus 20. Deferred taxes, went up by 50. Deferred taxes is an operating liability because it's non-interest bearing. So we keep the sign. So I've got an increase in accounts payable and I've got an increase in taxes payable. Increase in accounts payable, a plus 20. Increase in taxes payable, a plus 50. Or deferred tax liability, I should say. So my cash flow from operations, I got one piece of the puzzle, 88, a plus 88. Whether you do it directly or indirectly, you should get the same result. So my cash flow from operations, plus 88. Cash flow from investing, cash flow from financing. When I'm done, my change in cash better be a plus 795 or I did something wrong. Okay, otherwise I did something wrong. All right, so now I'm going to go to my cash flow from investing. That focuses in on the change in my non-current assets. You ready? So here are my non-current assets. I only have one non-current asset. So here's your ending balance, your beginning balance. So this is net of depreciation. You ready? You've got your beginning net book value of PP&E, given information 500. Plus what you buy that year, that would be an outflow, okay? I don't know if I bought anything yet. Minus current year depreciation, minus the carrying value of any asset sold, that's how you get your ending net book value. Ending net book value, 300, okay? Now, my current year depreciation, where do you get that number? Per your income statement. That was 200. How about the carrying value of the assets sold? How do you figure out the carrying value of the assets sold? So that's the question. How do we find out the carrying value of the assets sold? You ready? Sorry about that, guys. Your selling price minus the carrying value is your gain or loss. Your carrying value is your original cost minus your accumulated depreciation. Okay, that's how you get your carrying value. Your original cost minus accumulated depreciation. Many times for this kind of detail, you got to go to the other information. Okay, the other information. Do you all see machinery was sold? It had been fully depreciated. So folks, they didn't give me the cost or accumulated depreciation. They gave me something even better. If it's fully depreciated, what was the book value then? 0. Now, do you all see gain or loss? Where do you get the gain or loss from on the income statement? They tell me I had a gain of 30. A gain of 30. Okay, so a gain of a plus 30. That is per your income statement. So now you can back into, if it's not given, you can back into your selling price. This would be an investing inflow. All righty. So with a gain of 30 and a carrying value of 30, the selling price must have been what? 30. That's an investing inflow. Now I got to go back here and find back into what anything I bought, my outflow. First of all, the carrying value of what we sold was how much? 0. So now 500 minus 200, does that equal 300? Yes, it does. So that means what did we buy this year? Nothing. We bought nothing. Okay, we did not buy a thing. So since my book value beginning 500 minus the current year depreciation equals the ending net book value of 300, we know the carrying value of what we sold was 0, right? We backed into that. So we can infer that we bought nothing that year. All we have is an investing inflow of 30. That's it. So I go back here. What's my cash flow from investing? A plus 30. Now let's do our cash flow from financing. All righty. Now let's do our cash flow from financing. You could back into that 880 plus 30. is how much? Well, if we did this correctly, 880 plus 30, 880 plus the 30, 910. 910 minus, we got to have 795. What's got to be our cash flow from financing? It's got to be a use, a negative 115. So we could back into that. But how would we get that directly? How would we get that directly? Well, what's our financing activities? We go to our balance sheet. We look for our financing activities. You ready? Financing liabilities. I had a balance of 100. It's now at 0. So that's got to be a what? A minus 100. So we repaid debt. Let's keep track. Repaid debt. That's a financing outflow of 100. The principal paid, that's an outflow of 100. Financing outflow. What else do we have that's financing? Your stock. Your common stock. You ready? No change. My paid-in capital did not change. I did not issue anything. I did not repurchase anything. No change. Now, folks, you got to learn how to deal with your retained earnings. Even though they told me my dividends paid were 15, that is a financing outflow. 15. What's our financing outflow in total? As expected, 115. Our financing outflow is 115. Okay, that's our plug figure. If they did not, last item, folks, if they did not tell us dividends paid were 15, how could you back into that? How could you determine that dividends paid if they didn't give it to you? How would you determine that? Beginning retained earnings was how much? 110. What was our current year profit per the income statement? Well, the current year profit per the income statement was 400. Minus any dividends declared, which we're going to back into, there's your ending retained earnings. Well, my ending retained earnings is not 510. It's only 495. Why is it not 510? Well, we must have declared dividends of how much? 510 minus 495, 15. We must have declared dividends of 15. Now, be careful, folks. Just because you declared it doesn't mean you pay it. Remember, there's a two-step process with declared dividends. When you declare a dividend, liabilities go up by 15. Equity goes down by 15 because retained earnings went down by 15. It's when you pay it, cash goes down 15, financing outflow, US GAAP, then the liability goes down by 15. Equity, no change. You already reduced equity when you declared it. Now, again, I ask you, how do I know this declared dividend of 15? How do I know it's paid? Do you see dividends payable anywhere on this balance sheet? There is no dividends payable. Therefore, if there's no dividends payable, what you declared must have been paid in full. All right, it must have been paid in full. Got it? Woo, baby, I feel like I gave birth to a level 2 candidate. So, let's see. Before we run out the door, my buddy Chad's going to kill me if I don't do this. So hang tough, hang tough. Let's see. I want to get this. Let's see. Nope, that's us. Oh, man. Come on. Come on. Chad, I downloaded it. Hold on. Hold on. Nobody go anywhere. Hold on. Hold on. Please do me a favor. Do me a favor. Where did it go? Downloads. Downloads. Oh, no. Stay low. Oh, man. It's on the other computer. Oh, my goodness gracious. Chad, you're going to kill me. Chad, are you there? Oh, wait a second. I know what I can do. You guys all still there? You guys all still there? Don't look at my email. Nobody look at my email. Nobody look. Don't look. Don't look. Nobody look. Hold on. Nobody look. Hold on. No, wait. Is anybody looking? Oh, don't look. Forget it. Hold on. Hold on. Man, I can't find it. I can't find it. Oh, no. Let's stop showing. Stop showing my screen. Did I stop showing? You guys there? Hello?
I'm here.
All right, hold on. I'm going to show something 1 second. You ready? I'm going to share my screen again. Can you have me share my screen again?
I don't see it.
Share my screen. You know what? I think you've got to give me control again.
I never took it.
No?
No.
Oh, can you see my screen now?
Now I can.
All right, I love it. I love it. I love it. So let's okay. Let me do this. All right, folks. Let me just thank you again so much for attending tonight. If you're not familiar with UWorld, folks, UWorld is known for high stakes test preparation, whether it's law. I can tell you people studying for the bar exam, which means everything to them. If you go to medical school, obviously those exams mean everything to you. Nursing, but it's not limited to those. Obviously, CFA, CPA, all these different products we have. All right, CFA obviously is what you're concerned about. We've had some major changes here at UWorld, starting with UWorld acquired Wiley, as you know. And I came over, I used to teach for another company. I've joined forces, so we are really excited about what we've put together. It's really a collection of talent, folks. The wonderful UWorld people that were here to begin with. Sam Gottlieb, who's my boss here on the CFA side, incredibly nice, but he's as bright as the sun. And his team, who writes the content, does a lot of the teaching as well with me. Joined forces with Wiley, myself, Darren DeGraff, and others. So we're really excited about what this has done for us, not only on the instructional side, the content side, because of all the questions we've been able to combine. UWorld and Wiley, so the question bank is just phenomenal. So really, as you could see, like the questions I'm scrolling through, it's mind-boggling what we have available when you want to practice. I didn't introduce myself at the beginning. I'm sorry about that. But yes, I am a charter holder. I'm also an attorney, a CPA. So what I know is high stakes exams. I'm a professional test taker. I know what you're going through. You can and you will pass. All of these exams have something in common, folks. Incredible amount of volume, a lot of information. And the CFA Institute, while they sell the content, obviously, they're not really giving you the instruction in terms of, hey, how do we connect the dots between the different topics, right? That's a lot of what we bring to the table, because as you saw tonight, as I was mentioning, there's a lot of things, in accounting that you'll see in corporate finance or equity or debt. The CFA Institute content doesn't do that cross-referencing. That's a lot of what we do to make this mountain of information much more manageable. So in addition to the live lectures, we have, we have live online. We have these problem-solving workshops. We have these beautiful boot camps, which this is a sample of this Sunday. I think it's for sale. I'm not sure, but level 1, there's a discount if you guys wanted to join us for the boot camp. But we do all this for all 3 levels, and it's really amazing. Here, my friends at UWorld were so kind to put together this discount code. So if you're looking to enroll for the 2024 level 1 or 2024 level 2, you obviously have this fantastic discount code you could take advantage of. And yeah, I mean, listen, the volume of information, everyone's got their areas of expertise, but there's lots of areas where people, it's just not your strength. That's fine. In the world of CFA, no one expects you to be an expert, not even close in all these topics. Like, you didn't really see it from the start, but when we walk you through the content in the videos, we presume no prior knowledge. We'll walk you through what you need to know. And if you say to me, hey, Pete, I'm a CPA, I'm an expert in the accounting, go right to the questions. And you'll see in our software, you're either performing as proficiently as you should, or you're not. If you're not doing as well as you thought you would, then you have to go back and watch those lectures. But there's lots of ways with the technology to take advantage of efficiency, so you're not unnecessarily watching lectures or working additional questions on topics you're really good at. We want to make sure you're focusing your time wisely on the heavily tested topics and the topics where you need the help. But yeah, so this was what this was all about. We want to earn your business. We think the right thing to do is to make sure that you have an opportunity to see what the product is like. We hope we've earned your business for 2024. If you want to join us on Sunday, I think there's a 2-day boot camp. This Sunday is day 1. You could probably find out if you could just sign up for the boot camp. Sam, can they do that? If they just wanted to sign up for the boot camp, is there a way to do that or no?
I will find out. We'll actually have our marketing department send that out with the email to everybody. That's going to give everyone the link to the recording of this. I'm actually just not sure whether that is available or not.
Okay, so wonderful. But either way, you contact us, and we will, if it's available, we're happy to have you. I'm sure we are not going to turn down potential clients and customers. So if you're interested in joining, I'm sure we can make that happen. But that's all I got. Sam, were there any questions? Anything I didn't mention that I should?
No, I think everyone was really satisfied with what the information that was contained in there. So no, I think we can call it an evening.
All right. Thank you all so much for joining us. Sam and the team at UWorld, thank you for your patience tonight. Guys, we will hopefully earn your business. We'll see you down the road. Good luck if you're taking level 1 in 2023. Otherwise, we'll see you in 2024. Take care, everybody.
Thanks, everyone. I hope you all have a great rest of the evening, and good luck with all the study. We will send out an email to everybody with a link to the recording shortly, and you'll be able to watch Pete again and again and again. So thanks so much.
You got it. See ya.